Earnings bleed is finished, and there's upside to current consensus to like-for-like sales guide. Quite the rave review from BNP Paribas Exane.
Stocks come down a long way, an awful long way over the last few months. Okay, here we go. Time for the opening trade this Wednesday morning out of Europe. There is an awful lot to factor in, to price in. Let's see how that's reflected in the numbers. Here we go. FTSE 100, we're expecting actually to be fairly flat this morning. A little bit of green, but we're oscillating, I would have thought, either side of the plus and negative line here in London. So the FTSE 100 is up. Elsewhere, I think you're probably going to see a little bit of weakness creeping into the market. The Stock 600 is also out of the gate positively, but we'll start to see maybe that changing a little bit as we see the CAC, the DAX maybe coming through, and we'll see what trade looks like in those key markets this morning. There's a number of key sectors that we're going to be watching out for. All of this seems to be trading off what Trump had to say yesterday. We're watching what is happening with the defense stocks. We're watching what is happening with the wind stocks, trying to figure what is going to be happening there. But we've also got, obviously, this big tech story that we need to be pricing into the markets as well this morning here in Europe. Guys, what are we seeing? What is the story below the surface?
Before below the surface is kind of what we expected. I think you called this from the beginning, the energy effect, that wind effect. Those are your two biggest contributors to the downside. You're also seeing the likes of Shell, for example, really taking a beating this morning and actually weighing on the entire index. They're talking a little bit about that natural gas exposure as well. We're going to dive into the details later on, but Ørsted, Vestas are certainly down. To the upside, though, you are seeing a little bit of the healthcare sector regaining some of its losses. And your biggest index contributor to the upside is Novo Nordisk. And I think this one's interesting because, of course, it has taken a pretty big beating, I think 40% or so from last year's highs. On top of that, I just think the timing is so interesting here. On the same day, same 24, 48-hour period where you're talking about relationship between the United States and Denmark, the biggest export from Denmark to the U.S. is Novo Nordisk's Ozempic. I don't know if that's factored into the pricing. It could just be a technical move, but the coincidence is uncanny.
Yeah, we talked about the fact that Donald Trump didn't seem to have a plan of how he was going to get Greenland. Do you get to see it through a tariff? That's your point. Does Novo get hit by it? But also we were talking about defence stocks, and you're seeing the likes of Rheinmetall, Leonardo, Saab, as flagged by Joe, all up in the green this morning. Saab really up 2.5% there. But break it down by sector across the Stock 600. You've got about half in positive territory. Financial services leading the gains, up 0.7%. Consumer products and services at the bottom of the basket. And we've just had this report of French consumer sentiment unexpectedly falling amid all that political gloom as well.
Luxury's under quite significant pressure as well. L'Oreal, LVMH down. Hermes is under pressure, I saw just a moment ago. But Vestas is down by 4% now. Donald Trump saying he's not going to build any wind farms in the United States in his 4 years. Vestas is obviously highly exposed, but so is EDP. So are many of these European companies that are on this the energy transition story, this huge move that we could be potentially seeing. So a little bit of pushback there coming through. But the points seem to be coming. Like Shell is down pretty hard. That's adding obviously a lot of points to the downside. But luxury is a big drop today. Few tech stocks down as well. Infineon is down by 1.31%. But it does seem as if defense stocks are doing well. You've got wind stocks not doing very well. Luxury is the other big loser that we're watching here in Europe this morning.
Yeah, and I'm waiting for the full pricing to come in when it comes to the DAX as well. You are starting to get some of the opening trades there. We'll see how that shakes out in terms of that defense story as well. In the meantime, we posed that very question in U.S. programming to Jason Thomas, Carlisle, head of global research and investment strategy, about the Trump effect and what that means for Europe. Take a listen to what he had to say.
We have to wait and see what Europe is going to do in response to the U.S. election results. I would pay very close attention to changes in Europe. It's priced about a 40% discount to the United States. Obviously, market participants are not especially optimistic about the likely changes there. But that provides a pretty significant risk compensation to investors.
pretty significant risk compensation to investors. Could this be a tailwind for basically buying a little bit of bottom feeding? Let's bring in a true expert. Virginie Masseneuve, Global CIO for Equity over at Allianz Global Investors, joins us around the table. Virginie, we've been looking for a bull case in Europe for quite some time with very little success. Could this be that moment that the sell-off is so strong, that the doom and gloom around Europe is so strong, it's almost too cheap not to buy?
I agree. I think that you want to make sure you're not too underweight in Europe. You could have positive catalyst. It could be Ukraine. It could be more spending coming out of Germany with the new election and the new leader. There could be some green shoots, if you want, that have not been taken into account. All this said, growth is lower, but that's in the price. That's why you have to discount. Rates will probably be able to go down faster, as we've discussed. Trump tariffs is interest rates lower less fast or less cut. So I think all of this puts Europe into a position where if people are very underweight, they should have a position.
When it comes to what actually drives the index, I know so many people right now are talking about the growth story,
Yeah.
but given that so many European companies have that American exposure, I'm waiting for that consumer resilience story in the U.S. to bleed into Europe. Why hasn't it to a bigger margin?
I think the political element has taken over, to a certain extent in Europe. But you're absolutely right. A very large part of the European earnings are global, and somehow have not been reflected in the stock price. Somehow the concentration of the market, if you want, that we've seen last year in very strong global markets. I think we're up 40% from October 23 or, whatever the exact date is. But we've had 2 years of very strong rally. And I think in that you've had that concentration on the U.S., on part of tech, and a lot of the other, if you want, less glamorous stories have been ignored. And if you think 25 is a year of volatility, more erratic behavior, as we know, more unforeseen news coming out of Washington, I think you want to have that diversification, and you want to make sure that you find those companies at cheaper valuations with earnings potential.
If the S&P fell by 10%, would the stock 600 fall by 5% or 15%?
So what are the currencies going to do?
Okay.
Because that's the key. Again, if you go back to the tariff topic, if you look at 17, 19, tariffs, you've had a decline of the dollar of about 10%.
Yep.
So your return, are we talking in local currencies or are we talking in dollars? Yeah. In local currencies, I think you could have, given the valuations, and let's put France aside, given the political volatility that might come, I think France will come down less than the US.
Okay. How does that argument go down when you make it to US investors? Because in theory, they've got the strong dollar to factor back the currency story into the mix.
Yeah.
Europe looks super cheap. In theory, that should be a win-win. But when you make that argument, what do portfolio managers say?
Well, so it depends on the time horizon.
Yep.
It depends on, their benchmark. Do they really have a global benchmark? A lot of U.S. investors have a U.S. benchmark and then an international benchmark, and they play with the allocation. But I think there is...
Do they buy the argument around Europe being cheap?
I think they do.
Is it an argument that gets that gains traction?
I think they do. I think what's really interesting to me is to see if in 25 corporate America will see Europe as cheap and if we'll see more M&A.
Okay.
There's a lot of really good assets in Europe. Is there room for more M&A deals coming out because companies are cheap? So in terms of a massive capital allocation from U.S. investors to Europe, I think that's going to be very difficult. Massive, right? I think the home bias, as you know, in many countries, the home bias is still there, particularly if you have a strong currency on a hedge basis, maybe some allocation. Yeah.
Okay. Virginie, we've also been hearing this morning from Jensen Huang, who was speaking to our very own Ed Ludlow, talking about how he's up for meeting Donald Trump but hasn't been invited yet. I know you've been writing about semiconductors, how they're so strategically important, they're like a critical utility but not quite.
Yeah.
I'm kind of wondering if supply and demand is going to be so totally upended by geopolitics. As investors, how should you be thinking about that pricing in the industry?
Yeah, that's really important. And you're right. I wrote, well, we with the team wrote a note on semiconductors, the new utility. What I mean by utility is it's so critical. It's like electricity. The concept of national security really does that come first versus the concept of profitability? And when you see the ask, and when you see, for example, what some companies are doing in terms of building capacity in the US, you have to wonder. So I think it's going to be a mix of both. I think what you'll have is the high end of semiconductors, or the part of the supply chain that's linked to artificial intelligence, particularly if we see that impact on productivity increase from AI, service, impact on power demand, et cetera, continuing and intensifying. That part, I think, will continue to do well. But we have to take into account the fact that national security and semiconductors now are completely linked.
In terms of AI, when you've got the likes of Jensen Huang waiting for more imagination beyond his part of the chain, how do you play that in 2025, or how do you diversify as well?
I think you have to be diversified. I think you really have to think in that second generation of impact, on service and productivity enhancement, et cetera, et cetera. You have to think of not only the big guys, but also the smaller companies or the medium-sized companies who are going to be able to benefit more strongly. So it's a lot of bottom-up work. It's looking at it on a global basis, including in Asia, to make sure that you're not only concentrated in a few big names in the US.
Virginie, nice to see you. Thanks for stopping by to see
Thank
us.
you.
It was greatly appreciated. Virginie Maisonneuve, Global CIO for Equity at Allianz Global Investors. Let's talk about the Core 6 and see what's happening there. This is the centre of gravity here in Europe. This morning you've got Novo tracking a little bit higher, upgraded to buy at UBS. There's an attractive entry point according to the Swiss bank. You've also got Nestlé double upgraded at BNP Paribas. Both of those two stocks, it's interesting to see what is happening. Novo is actually reacting fairly positively. Nestlé, much more of a muted reaction. LVMH is down. We've got chips moving higher though. ASML, Schneider, both gaining traction this morning. Let's get some more details on those individual moves and what else we're seeing. Joe Easton joins us with more.
So we are seeing some movement in these wind stocks this morning, Guy. Vestas and also Ørsted declining around 4%, almost 5% on Ørsted. Of course, Donald Trump saying potentially that he will be looking to block all new wind projects during his term, and that would threaten potentially billions of dollars worth of projects. Remember, Ørsted did actually have a lot of cancellations in the US, so that is weighing on that sector today. Then in terms of defence, we are seeing moves higher there, as Lizzie mentioned a moment ago, seeing some decent upside, particularly Rheinmetall and Saab, as Trump says that he's looking for NATO countries to spend 5% of their GDP on defence. We'll have to see if that actually does go through, but they are moving on that news today. Then in terms of the bookies, some weakness in those gambling stocks today after Flutter warns it's been hit by gamblers doing well on some of their NFL bets, the sport I know absolutely nothing about, but we are seeing some weakness in the rival here, Entain, that one coming down almost 2% at the moment. Flutter in London, thin trading in that one. That did a relist to the US, as we mentioned earlier, nonetheless moving that market. Then in terms of TeamViewer, a big mover. Now this is the work-from-home technology company that rallied in the pandemic. It has had a big slump, but today beating expectations on their sales guidance. And look at that, 14% gain for TeamViewer in Germany, probably the best of the mid-cap stocks that we're going to get today. Then we've got morning calls. The first one, as Guy mentioned a moment ago, Novo Nordisk gets a buy rating at UBS. Now that stock, of course, plunged following the CagriSema data, which was disappointing. The participants lost less weight than expected, but as Guy mentioned, UBS reckons that is an attractive entry point now for that stock, so they go buy on Novo. Then finally, Nestlé. As you mentioned there as well, Guy, it is a muted reaction to the Exane outperform, but that is because Jefferies has actually cut the stock to underperform on the same day. So they've got a new outperform, new buy and a new sell over at Jefferies, which says the food outlook is weakening. So that is why we've got a muted reaction there. But Nestlé gets a couple of rating changes, unchanged at the moment over in Switzerland.
All right, Joe Easton from our equities team, we thank you bringing us the latest on those analyst calls. As we look at the stock 600, not doing much this morning, higher 0.1%. We had thought it was going to be a negative session, but really it's not as much of a muchness across European equities as a whole. We're going to dive into the impact of Donald Trump's pronouncements on winds next, as Joe was referencing. Vestas and Ørsted affected this morning. He says that wind farm construction during his second term in office is off the table. We'll discuss that next. This is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Minutes into the session here in Europe. It's half of it's up, half of it's down. There you go. We're not going anywhere in a massive hurry here in Europe this morning, to be brutally honest. There are individual sectors and individual areas that are really interesting. Take a look at what is happening with defense. Take a look at what's happening within the wind sector. Take a look at what's happening within the tech sector. Also interesting. And that's really where I think a lot of people are focusing their attention this morning. You saw a big dump in NVIDIA shares yesterday. This after a wide-ranging product presentation by CEO Jensen Huang. They failed to win over investors. Lizzie called it meh. I think that probably pretty much sums it up. He also spoke after that presentation to Bloomberg Technology. It was a wide-ranging interview. He talked to Ed Ludlow. He talks about the fact that he'd also be happy to meet President-elect Donald Trump and do what he can to help the administration succeed. I thought that was pretty interesting in terms of the narrative that we got coming through from him. In terms of the impact that we're seeing folding through into European tech stocks this morning, there is an effect. It's not that great. But you can see that there is an effect coming through from this. When US tech catches a cold, the rest of the sneezes, the rest of the world definitely, to a certain extent, catches a cold. But let's talk about what we can take away from what we've seen over the last 24 hours from Jensen Huang. We're joined by our executive editor for global technology, Peter Elstrom, around the table. That was a really interesting conversation he had with Ed Ludlow. We got a big market reaction, though. Why? In some ways, it feels like what Jensen's talking about and the market reaction feel like they're almost on different pages at the moment. Just kind of talk me through what you thought was interesting. What are your takeaways from the last 24 hours?
I think, in a sense, they really are on different pages. So this is it's important to remember, this is the Consumer Electronics Show that he's appearing at. He came out and he talked about consumer products in a number of different areas, including their GeForce graphics chips, which are really to drive these computer gaming machines that are so important to this segment of the market that used to be very important for NVIDIA. It still is important for NVIDIA. It used to be a majority of their shares, but now it's a small number of shares. He also talked about some of the new areas that are expanding into, including autonomous driving, some of the robot technology that they've got. But really what investors, I think, are reacting to is something quite different. What's really driving the revenue at NVIDIA these days is their data center sales, their ability to sell the AI chips that are going to be put into these data centers to be able to drive the AI models at OpenAI, Microsoft, Google, et cetera. That is where the big money is coming from right now. And he did not give as much of a status update on the progress in making those sales as perhaps investors had been looking for. So this focus on consumer products, I think, again, at the Consumer Electronics Show, may have conflicted a little bit with this idea of where the revenue are actually going to come from in the future.
But the diversification story still remains a headwind. And even though you look at the analyst commentary off the back of it, everyone's saying that they're still quite bullish on that long-term case. The progress, yes, I see as a potential headwind, but it hasn't, besides kind of paring back the stock a little bit, it hasn't really dented the momentum. And yet some of its big kind of tech peers also took a really big hit yesterday. Amazon, Apple, Microsoft, all the hyperscalers that are investing in NVIDIA. How do you make sense of that?
Right. Well, I think they still have to prove that this AI growth story is real and it's long lasting. Certainly right now, NVIDIA, because it's selling chips to all these hyperscalers out there, they're making lots of progress. The revenue's growing very quickly. They would like to see more progress about how quickly that's going to go at this point. But on the other end of the table, they have to prove that these services are going to be profitable. OpenAI talked in the interview that we had with Sam Altman about how much of a struggle it is to actually make money from some of these AI services at this point. They need to be able to get to profitability to make sure that they can keep buying those chips in the future, which matters for NVIDIA and it matters for really everybody in that whole tech supply chain. So we saw that kind of cascade across the tech industry yesterday as these concerns continue to bubble up because we need to see profitability at the other end of the AI model.
The actual tech aside, it was interesting as well when Ed asked Jensen Huang about tariffs, and I'm kind of wondering whether, Huang was extremely diplomatic here. Should he be banging down Trump's door for an invitation to Mar-a-Lago? How is NVIDIA actually going to be impacted by the trade war with China?
Well, it's certainly a big issue for NVIDIA in particular. They want to be able to sell into the China market. They want Chinese companies to be able to do business in the U.S. A lot of these CEOs grew up in an era of global trade, free and open global trade, and now they're looking at some potential headwinds on that front. So certainly he's been very aggressive in trying to sell the AI chips into China that he can. He's had a couple of different restrictions slapped on him by the Biden administration in terms of his ability to sell those. So I think he'd like to foster stronger relationships, let the businesses flourish and build their businesses. But the reality, the politics are we have Donald Trump coming into office on January 20th.
All right, Bloomberg's executive editor for global technology, Peter Elstrom, thank you. Good to have you round the table. I want to take a look at another industry that Donald Trump had his eye on yesterday. He was taking another dig at the renewables sector, saying that he's aiming to block construction of wind farms during that second term in office. Previously, he'd vowed to issue an executive order against the sector on his first day in office. And indeed, we've seen the hit to the wind stocks this morning, in particular Vestas. Those shares down 3.4%. As things stand. Ørsted even more so, down 4.4%. But let's get to Bloomberg's Rachel Morrison, who leads our coverage of gas, power and renewables in Europe for more. Rachel, just take us through how the shares are responding, why they're reacting this way.
The wind industry has been sort of braced and really dreading more from Trump on his plans for the sector. So we have in the past had some quite negative comments, and a lot of people are sort of putting that down to some of Trump's personal experience with a golf course in Scotland. So he sort of has said comments about how wind turbines are bad for whales, as in the sea creature, for which sort of have no evidence to support them. So it's not totally clear why he dislikes wind so much, but it really is a sort of growth sector, or was thought to be a growth sector for the US. So with Vestas, they would have expected to be selling turbines into the US. That's obviously looking less positive. And for Ørsted as well, they are a big developer, but also have projects in the US.
What impact can he have, Rachel?
Well, when it comes to permitting for new projects, he can have a lot of impact, so he can enact this, particularly for offshore wind or land onshore that's owned by the government. So not private land, but the leasing and the permitting for those projects can be blocked and can be stopped. So for projects that have already been permitted, they should be okay, but they'll be worried. But for new projects, this is really the sort of growth that will be stymied by this, potentially by what he plans to do.
So Rachel, walk us through kind of this geographic allocation here. If the U.S. wind sector is such a big piece to these companies, in the absence of that expansion, if that's what happens the next couple of months, where else can that growth come from?
Yeah, it will be interesting to see what happens, how Vestas, who sell wind turbines, react to this. There are other markets, Europe is already a lot more developed when it comes to offshore wind and onshore wind than the US. But there are pockets of growth in Central and East Europe where companies will be looking to sell into. The UK as well for Ørsted is a big market. So really the developers follow the markets where the best incentives are on offer. So those are CFDs, contracts for difference, things like that, subsidies, and then the turbine makers then follow that. So there are pockets of growth. They may look more to Asia, but for the moment it looks like the US will be a lot smaller of a market than hoped.
Bloomberg's Rachel Morrison walking us through that Trump story. Of course, you're already seeing it in the market reaction today. We thank you so much. Guy, you're the one who flagged this early on in this morning, that you might actually see some sort of ripple effect in Ørsted Vestas. Rachel was talking there about what the kind of driver of this might be. In the U.S., his base is not a fan of renewables. There's been a real point of contention in terms of spending from Biden as well, and perhaps that's one reason.
What's interesting, though, is red states have had a really big boost from government spend coming through into this space. So in some ways, that's quite counterintuitive for his base not to be in and on board with this as an idea.
Yeah, and I think it's also coming at the fact that some of the kind of big oil is not renewables kind of narrative is still so plagued into there. But you've seen the likes of major oil companies, Exxon, Chevron, who've actively, to cater to Biden's agenda, kind of rejigged their capacity, leaning into carbon capture, leaning into renewables, are now saying, wait, hold on a second, we kind of maybe want to keep that allocation that we've moved around on. So that's something to explore in the coming months, and certainly in the coming years as well. Coming up on the program, we go back to the markets. Europe's biggest equity bulls say the region can't beat the U.S. in 2025. That conversation next. This is Bloomberg.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice, because the US and China have already started the race, and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is the opening trade. We're 30 minutes into today's session and not much doing really on European equities. The CAC 40 in the red, though, down 0.1%. Maybe a bit of a hit from luxury there. You've got LVMH suffering this morning, but nowhere really making major moves this morning, Kriti.
Yeah, certainly something to keep in mind. Of course, this is through the broader market reaction. We're continuing to see a sell-off, specifically in the tech sector, Guy, when we were talking about that kind of pain that we had seen in yesterday's trade. Some of that's seeping into Europe, but I actually see SAP as one of the major kind of upside contributors to the Stock 600 this morning.
It's interesting, isn't it? Tech's actually doing okay here. It's a mixed bag, but tech is doing kind of relatively well. So that's an interesting story. What I'm watching as well is what is happening in the bond market. Yields are actually moving a little lower this morning, certainly on the 10-year tenor across most of Europe. Just want to check in on the 30-year just to see what's happening there, because that's where the action was yesterday. UK's down a little bit. Elsewhere, we're actually seeing long European bonds moving a little higher in terms of the yield story. This is the core of the story that we're watching so carefully at the moment.
Yeah, that kind of interplay between the bond market and the stock market. When it comes to the stock market, though, we've seen such a sell-off in Europe, this doom and gloom look. Is that a reason to be more bullish on Europe? Well, a few of our guests on the show think that maybe it's the right time. Take a listen.
You see these indexes that actually have performed well this year, some of them more than the S&P equal weighted, and therefore you shouldn't ignore them completely. Great companies, strong indexes, don't ignore Europe.
There's a few things that could give us hope that Europe is going to see, if not double-digit upside to the market next year, then at least very high single-digit upside.
In Europe, there's a lot of companies in today that meet our criteria of being long-term winners. It's the European stocks today that have been dislocated last year that I think look a little bit more interesting.
Feels like we start every year this way. Europe's going to outperform. We're going to get a better performance coming through. The disappointment doesn't take long to show up. Deutsche Bank strategists have also turned overweight on European equities, citing opportunities for stocks to tactically outperform US peers in 2025. The team led by Maximilian Uller expects a 50% upside for the Stocks 600 by year end. He joins us now. Max, good morning. Thanks for taking the time. What gets us to 50% upside on the Stock 600?
Good morning. Well, I think there are 5 reasons, actually. I think the political uncertainty is getting better or lower. I think we'll have very positive earnings surprises in in January, February, I think economic surprises are better than people kind of price in right now. I think China will be a positive surprise. Plus, look at the rates differential, right? We're talking about overweight Europe versus US. Rates differential between Europe and US, a lot more favorable for Europe than for the US. That's a very short summary. Happy to discuss.
Okay, so when you take those arguments to particularly US portfolio managers, what do they say? How much pushback do you get against this idea? How high is the barrier at the moment for people listening to what you have to say and committing capital to Europe?
Yeah, so I think US investors are quite far away from buying European equities yet. I think there are three phases. First one is rather short-term money moving back into Europe. We see an underweight or net short in hedge fund money. Then I think the next step will be European investors, and then lastly, US investors. I think for US investors, we need two of those triggers to really happen, and that is, one is better politics in Europe. So we need a new coalition, we need reforms. I think that will drag in more interest from US investors. And number two is really good, effective communication of the next stimulus program in China. That's also something that's perceived to be very positive for Europe. So once we have those two triggers, I think US investors will come back. But again, that are not these investors that I expect to come very short term.
Well, Max, let me follow on your first point, then we'll get to the China piece as well. When you talk about kind of the levels to buy here, we look at it a lot in terms of the rate space. And if you say hypothetically a 10-year at 4.50 or a 10-year at 5% could disencourage or disincentivize investment in the U.S., does the same apply here in Europe from international investors? If you see parity on the euro, does it incentivize more fund flows into Europe just from the currency move alone?
Yes, so rates and currencies, I think both are two aspects that are getting a lot more favorable for Europe. Look at the impact of a stronger dollar on earnings. I said earlier that we expect about 10% earnings beats for Q4 earnings in the coming reporting season, and that's not even yet pricing in the higher dollar. So the higher dollar is supportive also for European exports. I think that's a positive. And on the rates differential, I think 250 in the bond, that's really not hurtful. If you look at credit spreads in Europe, no problem at all. If you look at how the risk return is in economic data and the reaction function of rates, it's very different to the US, right? If we have weaker PMIs, for example, in Europe, we've actually seen a positive market reaction because investors are anticipating the ECB to be cutting more. If we have positive news flow on economic data, we barely see any reaction on the bund. Look at what we've seen with the inflation data earlier this week. Barely any reaction of the bund. That was more driven by US data. And very different picture in the US, right? You get stronger job data. Equity market is reacting more negatively because markets are already expecting 3% perfect US growth, and any disappointment will be a disappointment for equity markets. So I think pretty different in the setup. And again, stronger labor markets in the US, higher rates in the US, and that's been the key worry this week.
So that's the relationship with the U.S. Let's talk about the relationship eastward as well. You mentioned the China angle. We talk a lot about on the show what the China playbook should be when it comes to the European equity market. Is it as simple as buying and selling luxury? Is it as simple as buying and selling basic resources at a time when the Chinese are trying to pump in this fiscal stimulus with mixed results?
Absolutely. So I think it's too early. And I would still want to wait for the communication that we'll see probably later in March and how effectful that will be. But don't forget that our estimate, for example, is that we'll have 10% more fiscal spending in China in 25 versus 24. That's quite massive. That should have some positive result. I just think the communication so far hasn't really been that positive. From a sector perspective, we are not yet overweight luxury. I think for that one, it's too early. We still need to see results to get more credibility for those stimuli. For example, higher retail sales or sales in general in the sector. We haven't yet seen that. Maybe Q4 earnings season gives a first hint, but I think for that sector specifically, it's a little bit too early. But again, we have so many catalysts. China would be a little bit of a wild card late Q1 that would be, I think for that sort of industry, it's less relevant. And then again, for the banking sector, it's actually good news that we have higher rates because that means higher NII for longer. So yes, it's more of a drag for UK equities than it is for Eurozone equities. However, not as tough as it is for US companies, I would think.
And you're not really worried about all this latest inflation data that we've had this week forcing the ECB to be more cautious and giving less of a helping hand?
We think that the inflation data that we've seen recently, that they're very temporary, quite some base effects. Our view is that inflation will come back down below 2. And if you share that view, then I would think that we are very likely going to be at 150 in Eurozone rates by the end of the year. I mean, compare the current environment to the 2010s, you'll find a lot of parallels, right? We have inflation, which we, again,
very close attention to. I want to ask specifically about steel tariffs, because if there is no deal by the end of March, as you know, there will be steel tariffs between the United States and Europe. Are you prepared to support European industry if that comes to pass?
Regarding steel, there is no automobile or wind power industry without steel. So if we want to be able to build automobiles and wind turbines in Europe, for example, for carbon neutrality, we need a European steel industry. We will have a plan to protect the steel sector from global overcapacity while ensuring competitiveness. I'm prepared to explore both defensive and offensive actions with my colleagues at the Commission. This is a dialogue that we will have at the Commission. I still hope to convince the next U.S. administration that we have everything to lose from a collective trade war. Europe is an economic power with 450 million consumers and must be viewed as such. Our goal, our responsibility, is to be united as 27 nations to be able to negotiate.
The EU Commission's Executive Vice President Stéphane Séjourné there with our very own Oliver Crook in Brussels. Ollie joins us now from the Bureau. Ollie, I love that you asked him about steel tariffs, these quotas that are hanging over and basically on ice until Donald Trump takes office. What's the roadmap? How are the Europeans preparing?
Yeah, so listen, I mean, this is a new job, the Executive Vice President, technically, for Prosperity and Industrial Strategy. You know, we call it the Competitiveness Commissioner. And basically what he is tasked with is basically implementing a large portion of the Draghi report across a number of different industries. But again, one of the main focuses that they're going to have very, very early on is this question on heavy industry, because we have not got very specific details about the actual policy levers that they're going to pull. I think this was more of an instructive conversation in terms of how they're thinking about doing this. And really, I think for Stéphane Séjourné and this Competitiveness Commissioner, it's all about bridging the old industries to make sure that the old industries, that the new industries are dependent on, like steel for, say, wind turbines and automobiles, basically the old industries don't die, while at the same time investing aggressively in the sort of new industry. So that means supporting steel, aluminum, heavy industry, the autos, but also the chemical sector, to a point that there is enough of that in order to throw it forward into this sort of question about renewable energy, you know, battery technology and these sorts of things. But frankly, these are not the areas in which, you know, Europe is really winning right now. They do have some strong sort of wind companies. Solar, they certainly are not at all really players. And again, sort of the chemical sector and all those sorts of things are some of the things that have been the hardest hit. So the question I had for him, because if he's going to implement the Draghi agenda, a large part of the Draghi agenda is spending up to about 800 billion euros every single year. I asked him if it is realistic for them to do so without the use of joint debt. Have a listen.
Yes, it is realistic because, first of all, if we add the competitiveness policies of each member state plus the European budget, we are not very far from the investments that need to be made. I will push to implement the whole Draghi report and nothing but the Draghi report, all the components, including the investment aspects.
So listen, they need to implement this Draghi report. He's saying that basically they don't necessarily need to tap joint debt in order to do that. Again, this is a very sort of sticky and thorny issue. And I think once you get more concrete plans about where money would actually spend, you can actually start talking about that. We will get the sort of new clean industrial deal. That is something that we're going to get a lot more detail on. That will come in February. But again, these are sort of the way that they're sort of trying to frame this, going in not only to a sort of very more hostile environment with the Trump administration, but again, the prospect of a trade war between China and the United States. That means a huge amount of overcapacity coming into Europe, and that is something that is weighing on these officials right now.
Ollie, great stuff. Great interview. Thank you very much indeed. Ollie Crook joining us after that conversation. How does Europe progress from here and deliver on Draghi? Coming up, we're going to be talking more about what is happening in these markets. A firm focus on what is going on in the bond market still represents kind of the center of gravity, I think, for a lot of people right now. We'll talk more about that next. This is Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
Can you set the record straight? Is Greenland still not for sale then?
We have had that discussion already, and I don't think there's any good reasons to enter that again.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
No. I can't assure you. You're talking about Panama and Greenland. No, I can't assure you on either of those two. But I can say this. We need them for economic security.
Donald Trump speaking there yesterday, certainly putting the cat amongst the pigeons. The comments from Denmark's Prime Minister, that was back in September. President-elect Donald Trump speaking yesterday. This is still a live issue. Trump declining to rule out using military force to either seize the Panama Canal or Greenland. Let's bring in Bloomberg's Brussels bureau chief, Kevin Whitelaw, who's got long experience of covering these types of stories. Kevin, what should we make of the comments yesterday?
Well, look, I mean, this really was a throwback to sort of the freewheeling style that you know, we all sort of got used to in Donald Trump's first term, and it is a it is a reflection of what he's thinking at any given moment, but it's not necessarily something that tells you exactly how things are going to play out over the next days, months, or years. Greenland was an issue he talked about as president the first time round, and he talked about having an interest in it. It never ended up really going anywhere other than causing a little bit of a stir. He's obviously back at it now. I think the question down the line is going to be, what exactly does he end up doing? How seriously does he pursue it? And what does that really mean? You can see that Denmark is already trying to find ways to blunt some of this. They're saying that they're open to deals. They're ready to do business. Greenland's open for that. But at this point, obviously, there's zero interest in trying to indulge Donald Trump in the idea of somehow purchasing Greenland.
Well, Kevin, I just want to kind of nerd out on Greenland for a moment, because I want to argue the other side of this. Does he have a point here? I mean, when you Google this stuff, there is ancient Cold War doctrine that says the U.S. already has military access to this part of the world. Does he have a point in terms of pursuing whatever it is he's pursuing in this part of the world?
Well, I mean, to the degree that the U.S. may have national security interests, there's already a certain amount of U.S. military presence in Greenland. And so, the idea that the U.S. would like to expand that is something that actually could happen within the existing structures, right? I mean, this is all part of sort of NATO and other existing security structures. So it's a question of what exactly he is looking for here. And is he looking for something that is about sort of bolstering a military presence? Is it about access to some kinds of minerals? Or is he really looking for the prestigious idea of something that is about enlarging, the United States and sort of having the Trump purchase, if you like, and as sort of his real estate days coming back to roost. So I think ultimately the question down the line is going to be, what is it he's really looking for? And I'm not really sure, even though this issue has come up before, that people have a fully clear idea of why he is so fixated on Greenland.
Well, on the military theme, Kevin, he's also asking NATO allies to spend 5% of GDP on defence when the US isn't even doing that itself. Are we meant to take it that this is what he's going to do? Do we, by extension, take any of this seriously, or is it really all noise?
Well, I do think it has to be taken seriously, but maybe not literally. And so, obviously, Trump was pushed Europe very hard on defense spending in his first term, and a number of European leaders, including the former and current Secretary General of NATO, have credited him with helping to drive this issue and helping to focus European countries on the need to spend more on defense. Obviously, the war in Ukraine has only solidified that and made that more urgent. When Trump was president before, the target was 2%. We still have 2 or 3 countries that are just barely getting to 2%. And NATO itself is talking now about 3% as sort of the new idea of a notional target. If they get to 5%, there's simply no fiscal room in most European budgets and probably not the U.S. budget also, given the tax cuts that Donald Trump is talking about. But is Europe going to feel the pressure to keep boosting spending on defense? Yes. Are they going to feel the pressure to keep boosting spending on Ukraine? Yes, they will. And that's exactly what Donald Trump wants them to feel.
Yeah, you go for the maximalist approach, you push the numbers high, and then you maybe deliver a more realistic number. Kevin, great to catch up. Thanks very much indeed. Kevin Whitelaw joining us on the politics, the geopolitics. Let's talk about kind of what is coming up a little bit later on in terms of the data, Chrissy. Data moved the market yesterday in a fairly big way. And we saw the ISM services number really kind of moving things around. The JOLTS number can't be ignored either. Yeah, the outperformance that you're seeing basically in the United States continuing to take those Fed rate cut bets off the table, potentially more in the hours ahead. At 1:15 p.m. UK time, the ADP jobs data, the private basically numbers are going to come out, potentially kind of paving the way for what we're going to get on those non-farm payrolls as well. 1:30 p.m. UK time, some Fed speak from the Fed's Waller on the economic outlook, and then the ECB speak to fall that 5:15 p.m. UK time. Villeroy speaking in Paris. And then, of course, maybe the main event, 7 p.m., the FOMC minutes this morning. It's going to be fascinating. This afternoon. Yeah. Whenever it happens. This evening. I think it's 7 p.m. UK 7 p.m., time. So evening. So evening for us, close to bedtime. I'll be taking a look at what is happening. I go to bed early. So does Valerie, I suspect. She's sitting around the table joining us to discuss all of this. We could get a hawkish set of minutes, which would be interesting as well, because that could even add extra juice into this bond market move that we're seeing right now.
Yeah, the question is just how, the market's already very much adjusted to the hawkish surprise we got in December. Is there really going to be anything in these minutes to kick it more, right? Yeah. Well, right now, the market is pricing in a Fed on pause until July, so that's a substantial amount of next year where the Fed isn't active. Maybe we do get some hints in this minutes on just how close that call was to cut rates in December, maybe foreshadowing, that descent that we did see. Maybe this Fed is going to be on hold longer than they expected. The cementing January is what we might, get from these minutes, but it's not going to surprise the market very much. What I do think the market is going to focus on is the political side of the story for the Fed. We heard from Fed Chair Jay Powell in the press conference talking about some members already having adjusting their forecasts, preempting these economic policies we're likely to get out of Trump. Just how much did that play in the discussion? Just how much did that play in their revisions to growth and their upward revisions on core PCE growth for 2024? I think that's what the focus is going to be.
You had Ben Rahm earlier on the program talking about a 1 standard deviation move being anywhere from 330 to 550. That was the range. He suggested at least that the Treasury markets are pricing in. Is there a case for 350 on the 10-year?
Look, we would have to see a very big shift in the economic outlook for the U.S. We'd have to see this economic data turn around. We've not gotten that at all yet. We've had a string of hot data to start the year. Maybe NFP on Friday changes the tune, but to get a big rally in the Treasury market, we'd definitely have to see some weak economic data.
All right. Bloomberg's Valerie Teitel walking us through the Treasury market dynamics. And we had her this morning, like I said, saying what is actually driving these markets. And she gave me a laundry list of things. There's just no way to narrow it down because everyone is hedging and preparing in a different way.
We're waiting for Trump. We're waiting to figure out. That seems to be the biggest variable right now. Yeah. What happens on the 20th? What are we really going to learn? Everything feels like preparation for that.
More uncertainty. That's what happens.
Yeah, the uncertainty is there's just, as Valerie says, just multitudes of multiple factors being folded into the market at the moment. But how much of it's accurate and how much of it's not? This feels like a really difficult January to navigate. Ed Bastian's going to be joining the team a little bit later on. That conversation from the Delta CEO coming out, I think, of CES. Looking forward to hearing what Ed has to say about the global economy. That wraps things up for the opening trade. The Pulse is coming up next. Hope you enjoyed the show. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Donald Trump wraps up his foreign policy rhetoric, threatening to absorb Canada, seize the Panama Canal, and take control of Greenland. Well, NVIDIA suffers its biggest single-day drop in 4 months after the chief executive, Jensen Huang's presentation fails to propel the AI chip maker to new heights. Plus, a growing concern about inflation leads to a sell-off in treasuries as yields march higher. Now, good morning, everyone. There's really quite a lot to unpack, so let's take a look at the European markets map. Again, the focus is firmly not only on inflation, but what some of these policies and possibly inflationary tariffs mean for the world. Inauguration date, January 20th. Again, there's quite a lot that's coming from President-elect Donald Trump. A lot of insiders in the market say, look, do I treat it as policy? Do I trade on the back of it? Do I get prepared? So that's the million-dollar question. The CAC 40 down 0.2%. The FTSE, the DAX, and actually the FTSE Mid gaining about 0.2%. Now, cross-asset, we firmly look at to some of the bond prices, fixed income, left, right, and center, because of debt concerns around the world. S&P futures gaining some 0.2%. The U.S. 10-year yield 4.67. Look, it's a big week for UK debt because of the amount of issuance. It also raises the question if the UK 30-year yield continues moving in the way it has over the last couple of days, whether the Chancellor will be forced to raise taxes further, and then euro-dollar 103.19. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Trump and tech definitely dominating the news this morning. In a moment, we'll talk NVIDIA with Bloomberg's Peter Elstrom. But first, let's bring you the latest on Donald Trump's foreign policy threats. Now, in a freewheeling press conference, the president-elect said he would use economic force to make Canada a part of the United States. He also said he would rename the Gulf of Mexico as the Gulf of America and declined to rule out using force to seize the Panama Canal and Greenland.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
No. I can't assure you. You're talking about Panama and Greenland. No, I can't assure you on either of those two. But I can say this, we need them for economic security.
Well, Panama has already vowed not to give up the shipping channel. Denmark saying, while it welcomes U.S. investment in Greenland, the world's largest island is not for sale. So let's bring in Ross Matheson, Bloomberg's EMEA News Director, and then we'll talk with Peter Elstrom about everything tech. So thank you both for joining us. Ross, it was kind of like a wild press conference because you don't know what's policy, you don't know what's legal, you don't know what's kind of setting the tone. So how should we have taken the press conference?
Was vintage Donald Trump in a way. It's very reminiscent of his first term. Well, often in press conferences, he will range over multiple topics in quickfire fashion: domestic politics, the state of the world, the state of his businesses. And it's very much a question of reading through all of that for what is tangible, because often it's a lot of rhetoric, and in the middle of that, there'll be an actual policy announcement or position. So filtering all of that is quite difficult. But what's very clear from this press conference when it comes to foreign policy, at least, is that he's very much going to be tying everything in foreign policy for what he sees as the best interests of the US, and the US doing deals, for the US economy. So it's all about putting these comments out, putting these threats out. Does he really intend to use military force against Greenland? No.
but it's about going to the extreme with his comments to create leverage for him to extract concessions from countries when it comes to the U.S., and that's really what that's all about.
And Roz, it will make it very complicated for Canada and Mexico, the neighbors of the United States. I mean, Canada, we saw the news yesterday with Trudeau stepping down. How do leaders, either incoming leaders or leaders at the moment, deal with his rhetoric?
Well, that's the question, because you've got, of course, your domestic considerations here. You can't be seen to be bending to everything that Trump says. Equally, you need to manage the U.S. relationship. For a lot of countries, the U.S. relationship economically, trade, investment, markets is important. You can't ignore it. And so how do you thread the needle between, in a way, giving Donald Trump some of the things he wants, that he can claim a win, he can say, look what I got from you, while also holding your ground on things that are really important to you. So for leaders, be it in allies like Canada, who are right next door, countries that are seen as adversaries of the U.S., like China, Europe very much, a long-standing ally of the U.S. How do you do that where you seem to be not bending too much to Trump, but you are giving him enough that he can claim a win?
Yeah, and I've heard from insiders that actually he's taking so much space that they worry that their leaders will spend too much time dealing with Donald Trump and not about domestic policies. Let's also talk about tech. NVIDIA shares falling more than 6% yesterday after a presentation by company chief executive Jensen Huang actually failed to give the near-term upside that some investors were seeking. So if you look at pre-market, it's gaining some 1.5%, but not the stellar gains that maybe some analysts were expecting. Huang also spoke to Bloomberg Technology in a wide-ranging interview, saying he would happily meet with President-elect Donald Trump.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
So let's also bring in Bloomberg's executive editor for global technology, Peter Elstrom, who joins Roz and I. Peter, thank you for joining us. I mean, I guess the concern again is if you're a big tech CEO at the moment, do you need to go and kiss the ring in Mar-a-Lago to make sure that Donald Trump doesn't take action against you?
Well, tech executives, business leaders more broadly, are certainly paying attention to all the things that Roz is mentioning here. That Donald Trump is out there making proclamations that we just haven't heard from a U.S. president in the past, making these kinds of statements. And CEOs like Jensen Huang will talk a bit about Mark Zuckerberg also at Meta. They're paying very close attention to what's going on. They are making donations to the inauguration committee. They're going and talking policy with them. They're making some adjustments internally also to make sure that they're orientated as this Republican administration is coming into office later on this month. So they're very aware of the importance of these kinds of policies, and they're trying to position themselves to do as well as they can going forward. We heard that from NVIDIA. Jensen Huang said he'd very happily meet with President Trump. They have a lot of business that they have to do with China in particular, and they want to make sure that they can adjust as much as they can to keep that business flowing.
So Mark Zuckerberg gave the speech yesterday that he posted everywhere, basically saying that they'll get rid of the 40,000 moderators because of free speech, which means that you don't have a curated content on whether it's fake news or not, but contributors will be able to do that. I mean, is that pandering to Donald Trump?
It's certainly a nod to the Republican administration that's coming in. They had a range of fact checkers that would look after all sorts of content. Realize tech companies have made a kind of elegant solution here where they don't handle this fact-checking themselves. They hire outsiders to handle it, so they have somebody to blame if anything goes wrong. Right now, Mark Zuckerberg is saying they've been too politically biased. They've been doing things that we don't agree with. It's unclear whether that's actually the case because, of course, they had control over this relationship. But there were cases where they were keeping certain discussions around, say, COVID or right-wing extremism. They were keeping that off of the platform that drew a lot of fire from the Republican administration. So now Zuckerberg is saying, hey, we're going to do exactly what X is doing, what Elon Musk has been doing at X, where you can say almost anything that you want, and we're going to let the community discuss whether it's accurate or not accurate. Zuckerberg even said, we're going to try to fight this wave of censorship with President Trump. He wants to be able to get the Republicans on board with this idea. So certainly, yeah, it's a nod to the Trump administration.
And Bloomberg Pursuits actually also spotted he was wearing a 900,000 watch. I mean, Bloomberg Pursuits is around that looks at luxury goods. So really quite amazing spot.
I didn't know watches got that expensive, but yeah, maybe that was a little bit of a distraction from his central message.
Yeah, I didn't either that you could buy one for 900,000. Rosa, is there basically policy, changing without Donald Trump really doing anything, because a lot of chief executives may want to align. So before they get told, they change how they operate to make sure that they have the Trump administration on side.
We know that was happening even before the election, in a way, during the campaign. I mean, we saw companies, we saw administrations sending delegations to the US trying to work out, you know, A, is Donald Trump going to win? And B, how do you deal with the second Donald Trump administration? So really trying to prepare themselves for months last year for this eventuality. And of course, perhaps taking policy decisions ahead of that to show, yes, we are sending money to the US, yes, we're investing money here, we're keeping some production here or returning some production to the US. At the same time, we still want to be able to invest and do business overseas, be it a US company or whatever. So they're trying to show, again, it's all about showing, you know, that you're doing something, and, you know, smart companies, as Peter was saying, are kind of preparing for that already. Certain administrations are trying to show that. So they're trying to thread the needle, really, to be able to, you know, have, you know, stay out of Donald Trump's crosshairs, because, as you can see, like Denmark, you don't want to be in them relentlessly with Donald Trump at the moment. So stay under the radar, give him a few things that he wants, but also generally be able to set your own policy.
Thank you both for joining us. Peter Elstrom, Bloomberg's executive editor for global technology, and Ross Matheson, our EMEA news director. Now, coming up, we'll look at the impact of Trump's foreign policy threat on markets. That's next, and this is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Well, the U.S. president-elect's tariff threats and policy plans continue to dominate the economic landscape, and investors are trying to make sense of what they mean for markets. So let's discuss all of this with Derek Halpenny, head of research for global markets, EMEA, and international securities at MUFG, and Catherine Nice, chief European economist at PGIM Fixed Income. So thank you both for joining us. Happy 2025. There's a lot to try and wade through, Catherine, which is like Trump policies, tariffs, and inflation. I mean, at the end of the day, are we only going to have a good new year if there's inflation's under control, and how much is that dependent on Trump policies?
You know, one thing that I often think of is Q1
has been sending us curveballs for a number of years over the last 10 years. So we had Snowmageddon, we had the longest government shutdown, and then it just seemed to get bigger and bigger challenges hitting us, Ukraine war, tariff wars. So you do wonder a little bit, what's Q1 going to throw at us this year? I mean, to start off with, though, things look like we're going to see a bit more of the same in 2025 relative to 2024. Decent, subpar, but decent growth, inflation coming back to target. But there are these big risks. And some regions are definitely more vulnerable than others, Europe being an obvious region that I cover and look at that is vulnerable to these tariff threats.
Yeah, and that actually changes everything also for euro-dollar. If you have a U.S. exceptionalism, what does that mean for dollar going forward, Derek?
Well, I think the key point to make for the start of the year is what's happened in Q4. So we've had an 8% strengthening of the US dollar, euro dollar specifically, 112 down to below 104, 103. So there's been a big move. So I think from a tariff perspective, you've done nearly 10% of dollar strength, which would take care of a 10% tariff, if you like. When you look at the rates market, I would also say that quite a lot is priced in terms of that divergence in economic performance between the US and Europe. And where I would say I'm a bit concerned in terms of the relative pricing is there's a lot of expectations that this US exceptionalism is going to continue in 2025, but we shouldn't ignore the forces of economic cycles, and the restrictiveness of monetary policy is still there in the US. And I think later this year, we could start to see more evidence of slowdown in the US, and that's not priced.
Yeah, Catherine, what do you think is priced in? I mean, again, fixed income has behaved a little bit differently to other asset classes, but there does seem to be this, belief held in the markets that actually the US wins and everybody else loses.
So if you look at the U.S. economy, it's true that top down, the theme has definitely been surprising resilience. But, as has been mentioned, if you look under the hood, if you look at some of the more granular data, you are seeing that cyclical weakness. You are seeing that sensitivity to restrictive rates that is going to continue. And so I think there is this risk that, maybe the economy is going to slow a little bit more than what markets have been expecting. They have sort of oscillated around extremes of, if the data comes a little bit weaker, it starts to price in these huge number of cuts. And if the data comes in stronger, they all get priced out. And maybe the truth is going to end up somewhere a little bit more in the middle. So at the minute, I think we've got, less than 2 cuts priced in for 2025. Maybe, the reality is going to be something more like 3 cuts. So not hugely different, not a massive, aggressive cutting cycle ahead of us, but a little bit more than what is priced in. More softness there, I think, than's priced in.
Derek, I mean, it's unclear at the moment what Donald Trump says is actual policy or if it's just his thoughts. So yesterday he said something about interest rates being too high. I mean, will markets move on things like that? Or are we bracing for a Fed showdown?
I think markets are fully expecting these kind of comments and verbal interference, let's call it. I think markets will become concerned perhaps later this year when maybe then we start to get an impression from Trump in terms of who he might be picking to take over from Powell in 2026. And that starts to become priced potentially in late 2025. And that's an issue where I think markets could start to respond. Other than that, if he truly believes rates are too high or the dollar's too strong, well, look at your own policies, obviously. And that's what's being priced in at the moment. So if there's a shift in policy because of that, then that's obviously more meaningful.
I mean, do you, I don't know whether you can tell whether he wants and will put policies in place to lower dollar. Is that impossible? I mean, it feels like the impossible question to understand how far he'd go.
Well, the only obvious near-term risk of the dollar reversing weaker is that come inauguration and the days following, the tariff announcements are actually less aggressive than what's priced into the market. And we saw a little snapshot of that with the Washington Post article suggesting that dollar dropped 1% very, very quickly. Of course, then Trump denied it, and we've reversed a good bit of that. So there's your near-term risk. It's policy-related. Perhaps he's less aggressive. But certainly, listening to him in Mar-a-Lago yesterday, if anything, he looks to be going more gung-ho, and he seems to really believe in tariffs. So I'd be surprised if he doesn't go full on and kind of meet the market expectations in terms of what's priced.
Catherine, very quickly, I mean, when do we worry about U.S. debt?
We were just having a conversation about this.
Yeah.
You know, it's a dismal science, economics. It can't tell you a specific number where markets get nervous, and it all comes down to credibility. At what point is the fiscal outlook no longer credible from an investor perspective? When does it look like, you know what, I'm not really sure I'm going to get paid back? And it's so difficult to put one's finger on that, but when it happens, it tends to happen very quickly. And this has been a question that has come up a lot, so clearly the risk is live. To me, the acid test is growth. As long as the U.S. economy is growing, and it grew at a really good clip in 2024, as long as we see that growth, and that growth also looks like healthy, sustainable growth that's coming from investment. So you're growing not only today, but the chances that you're going to grow a lot tomorrow are sort of being hardwired in through that investment, through the labor market, then that credibility, I think, can withstand. Once you see chips in that, I think you'll get the concerns.
Okay, guess what? We'll talk about the UK next. Catherine Nice from PGIM and Derek Halpenny from MUFG. This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world, only on Bloomberg.
with us, Derek Halpenny from MUFG and Catherine Nice from PGIM. Derek, we're talking about debt in the U.S., debt levels. How do you see it playing out?
At some point, again, going to Catherine's point earlier, you can't say exactly when, but I feel it's coming maybe sooner and possibly this year, that those cyclical factors that we spoke about. Investors don't care about deficits when growth is strong. They care when growth starts to weaken. And when you look at the figures, they're mind-boggling. Debt servicing costs going to be over $1 trillion. That's more than the entire budget deficit in 2019. And then when you look at the first 2 months of this fiscal year, the deficit is up 20% when you strip out timing issues. And these are supposedly good times. Why is that happening? And at some point, you may start to see the economy slow, but rates possibly, certainly not coming down, maybe even going up again. And then that's when I think investors start to take fright. That's when it starts to have a bigger impact on asset prices. And then very quickly, it can start to unravel and become a bigger issue for the markets.
And the catalyst?
Well, who knows? If we did, I think we would be doing well. I mean, it could be, potentially coming from Europe. We've seen a lot of issues around debt sustainability in France. We had in the UK this Liz Truss moment, and I think these sort of sentiment shifts can happen in a way that are unpredictable. If we saw, that France, for example, I think is going to be in a very difficult spot for at least the first half of 2025. If that acted as a trigger for market sentiment that got eyes to focus more directly on the U.S. and say, hang on a minute, the fundamentals here just don't add up, and I'm getting nervous, that could potentially be a trigger.
All right, thank you both for joining us. A lot to think about for the start of the year. Derek Halpenny, Head of Research for Global Markets, EMEA, and International Securities at MUFG, and Catherine Nice, Chief European Economist at PGIM Fixed Income. Coming up, we take a look at what lies ahead in 2025 for global investors. We're joined by Co-Chief Investment Officer of Sixth Street, Julian Salisbury. That's next, and this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump ramps up his foreign policy rhetoric, threatening to absorb Canada, seize the Panama Canal, and take control of Greenland. NVIDIA gains pre-market after suffering its biggest single-day drop in 4 months. Plus, growing concern about inflation leads to a sell-off in treasuries as yields march higher. So inflation concerns are weighing on the market as investors prepare for what's in store in 2025, including the new Trump administration. Our next guest remains bullish on real estate and tech innovation in Europe. We're joined by Julian Salisbury, the co-chief investment officer of Sixth Street, a global investors with $100 billion of assets under management. Julian, thank you so much for joining us. So you're quite bullish on the UK, which is quite refreshing because a lot of people think it's US first. Everything will go to America in terms of economic prowess and almost, global supremacy, and everyone else will lose.
Look, clearly the U.S. preeminence theme is strong, and it's hard to see what's going to, reduce that. You look at what's happened to relative market caps, relative valuations. But that doesn't mean there aren't great investment opportunities here in Europe. When I was here 6 months ago, we talked about, this higher for longer environment was going to keep asset prices under pressure. It was going to result in more capital structures needing amending. But I also think, we talked about then, this was ahead of the UK election, that notwithstanding the uncertainty of the outlook, that, we were going to find opportunities to invest here in Europe, and we were very active during the course of 2024. So, we're putting our money where our mouth is as well. We made a couple of the larger investments in the UK, one in real estate, one in private equity. We were very active across our direct lending franchise. So it's not at the expense of the US, but I'm saying just because the US is very interesting and exciting, there's a lot of things attractive about their market, doesn't mean we can't find areas to deploy in Europe.
So what happens in 2025? Will you deploy more money in the UK compared to the rest of Europe?
Look, again, if you think about the way our business is set up, we don't have a specific day one or the beginning of the year asset allocation. We want to put X in UK or X in Europe or X in the US. It's more about bottoms up, originating great deals, companies with strong unit economics that are capable of withstanding a variety of economic outlooks so that we're not subject to the vagaries of rates being up or down 50 basis points, policy tariffs influencing things in our portfolio. And if that, last year, it just so happened that there happened to be a couple of very large investments in the UK. It may be that there are none in 2025, but my expectation is that we'll be as active, if not more active, in 2025 as we were in 24.
10 billion? Less than 10 billion? Give me a number.
Well, so last year, it was 2 billion euros that we deployed across our direct lending franchise. That was pan-Europe, across 13 different transactions. We had on the real estate side in the UK, it was a little north of 1.5 billion. In the private equity space, a little over, it was one large transaction towards the end of the year that was about £400 million. So, that gives you an order of magnitude of the scale of the business last year, and I would expect to do more during the course of 2025.
Julie,
as long as opportunities present themselves that make sense to us.
I was going to ask you about opportunities because you see, the UK is in a debt concern trouble, and of course, if you speak to our chief economist, he says, look, debt levels are rising across the world. It's just as soon as the market loses faith in the UK, then it spells trouble. Does that give you more opportunities?
Look, I think we talked about this 6 months ago, right? That there are concerns about that we have to share about the UK economic outlook, but that also results in less capital being here, less vibrant capital markets, less highly valued public markets, less active public debt capital markets, less private capital. I mean, there's certainly competition here around every deal that you look at, but on a relative basis versus the US, less. So I think that concern or reservation about the UK means that we're able to find great things to do. I mentioned one deal, Wingstop. It's a chicken franchise business here in the UK. It's a great entrepreneurial story. It's a story of three UK entrepreneurs who started a business from scratch in 2018, built this thing up using family office money, private capital money. The company needed to move to the next stage of growth. They'd outgrown their existing capital sources. We step in and provide them private capital to continue their journey for many years to come. We think they have the ability to multiply in size from where they are today. And at some point, there may be a public exit option, there may be other opportunities, but it's that business is such a secular grower. You know, UK growth plus minus 100 basis points, rates plus minus 100 basis points doesn't really matter.
And no concern about, you know, capital leaving because of non-dom rules or the budget. And again, does that make more attractive to find assets, or is it still a question mark?
Yeah, look, I think we talked about this last time. I think the UK should be embracing its historic position as a centre for finance and trying to encourage more people to come here and attracting talent rather than pushing them out of the UK. You may not notice the damage that that's doing immediately, but, you know, 5, 10, 20 years from now, it'll become obvious. So I think the UK should be doing everything that it can to bring investing talent and financial services talent, keep it in the UK and attract more back into the UK.
But what do you think? I mean, do you have a clear understanding of what the UK economy wants to be? So is it manufacturing? Is it entrepreneurs? Is it legal services?
Right.
And again, you know, given that, does it mean that you go for different opportunities?
Yeah, again, it's very, for us, rather than having a broad kind of policy about we're going to go into this sector, many of the deals we look at here are quite opportunistic in nature.
Finding the right deal.
Finding the diamond, you know, in the rough, finding the needle in the haystack. So
and that's what good founder, a good CEO?
Yeah, look, again, the one deal we did earlier this year, Carla, it's a home builder. It was owned by an insurance company. They were looking to recycle capital. It was a win-win for them. They got to sell what they deemed to be a non-core asset. We got to buy a great business that we thought was a reasonable valuation. We think there's secular growth ahead of that business. You know, we may not do another deal like that. It was a bit of a one-off. The deal that I mentioned with the Wingstop franchise, we happened to know that company very well. We had an existing relationship with the U.S. business that gave us particular insight into the business. We may do, you know, one more of those next year. We may do 0. It's very much like idiosyncratic deal by deal.
Julian, anything in Europe away from the UK?
Look, I think across Europe, as I mentioned earlier, we continue to be active in our direct lending franchise. This is supporting a variety of sectors. We continue to be strong in B2B, enterprise software lending, but we also are active across healthcare and other areas. Some of that's sponsor-backed activity, some of it's non-sponsor-backed activity. I do think that we're likely to see a higher level of M&A activity in 2025 than in 2024, so that will be supportive of us growing that business broadly as we support our sponsor clients across the region.
Julian, thank you so much for joining us. Julian Salisbury, their co-chief investment officer at 6th Street. Now, coming up, we'll hear exclusively from the EU's industry chief, Stéphane Séjourné, with his thoughts on the upcoming Trump presidency. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Now, the EU must be ready to defend itself from possible punitive trade measures from the new U.S. administration. That's a very clear message from the EU Commission's Executive Vice President, Stéphane Séjourné. Now, he spoke exclusively to Oliver Crook about how the bloc plans to respond to the new administration.
Europe will remain an open market and will not become a closed one. There's no gain in a trade war. However, Europe cannot be the only continent open to global overcapacity. Across the globe, markets are increasingly protective, with state aid marking our industries uncompetitive. This must be addressed. We have both offensive and defensive trade instruments that we must activate as part of a comprehensive economic strategy. This marks the end of European complacency or excessive openness. We need to protect our industries when they are not operating on a level playing field.
And one of the great risks to the European economy and indeed to European industry will be tariffs that have been promised by Donald Trump, obviously something that you're paying very close attention to. I want to ask specifically about steel tariffs, because if there is no deal by the end of March, as you know, there will be steel tariffs between the United States and Europe. Are you prepared to support European industry if that comes to pass?
Regarding steel, there is no automobile or wind power industry without steel. So if we want to be able to build automobiles and wind turbines in Europe, for example, for carbon neutrality, we need a European steel industry. We will have a plan to protect the steel sector from global overcapacity while ensuring competitiveness. I'm prepared to explore both defensive and offensive actions with my colleagues at the Commission. This is a dialogue that we will have at the Commission. I still hope to convince the next U.S. administration that we have everything to lose from a collective trade war. Europe is an economic power with 450 million consumers and must be viewed as such. Our goal, our responsibility, is to be united as 27 nations to be able to negotiate.
Now, the EU Commission Executive Vice President Stéphane Séjourné there, well, Bloomberg's Oliver Crook, who did the interview, joins us now from Brussels. So, Ollie, good morning. European industry clearly under threat. Do we have a roadmap on how to support it?
Yeah, so listen, Francine, it was really interesting to speak to Stéphane Séjourné, who is the Executive Vice President for European prosperity and for industrial strategy. This is a new job that has been developed under this commission, and it's really supposed to be the executioner of much of the Draghi agenda on the issues of competitiveness, yes, for industry, but really across the sort of wider map. I think that what we got from Stéphane Séjourné and what is more about the sort of not the specifics of what the exact levers that they're going to pull policy-wise, but more of an understanding of how they're going to sort of begin to attack this. I mean, he's been in the job for about 40 days. And really, I think that the challenge for him and what he's sort of trying to do is to bridge this sort of gap that exists between the old industries of Europe, i.e. heavy industry. We talked about steel, we talked about aluminum, the auto industry, as well as sort of the chemical industry, bridging that to the sort of industries of the future. So making sure that the old industries of Europe don't die and that there are enough of them that still remain in order to service some of those new industries like, say, renewable energy, say, wind power. But there are a lot of those industries where Europe is way behind, whether it's battery technology, whether it's solar panels. These are not places where Europe is winning right now. So that leads to the next question. Part of the Draghi agenda is spending a huge volume of money every single year to try to achieve those ends, up to 800 billion euros. The other question I asked Stéphane Séjourné is that achievable? Is that realistic without joint debt? Have a listen.
Yes, it is realistic because, first of all, if we add the competitiveness policies of each member state plus the European budget, we're not very far from the investments that need to be made. I will push to implement the whole Draghi report and nothing but the Draghi report, all the components, including the investment aspects.
And so part of his task is going to be unlocking additional funds. Could they set up additional direct investments funds at the EU level to help member states sort of make these sort of strides that they need to do towards more competitiveness? And that is really going to be the sort of the task for this agency going forward. And we're going to get a lot more detail on that when we get the clean industrial deal that'll be published at the end of February.
So, Ali, what are the biggest obstacles to the competitiveness agenda? Does it always come back to money?
Yeah, I mean, money is certainly one of the big ones, Francine. That's one that's sort of a big focus. I think that one is also in part of the nature of the EU, how slow these things move, how much consensus you need. Let's also remember that the EU functions very differently. It's not a national government. It's not like in China where you can have a lot of direct state-backed action that is unilateral and is just kind of do whatever you want. It's not like in the United States where you have the Inflation Reduction Act and you can create all these sort of tax incentives. The EU doesn't quite work that way. So it's not as clear the way that they can sort of pull all of these levers. The other problem that we have, Francine, in Europe is that there is just not this sort of political unity that there is in order to make these great strides forward, these leaps forward in terms of European unity. I mean, look at what's going on in France, look at what's going on in Germany, and also let's not underprice what's just happened in Austria. We have a situation where now another leader of a 27 euro state, these are people that are making decisions, sitting at the table. The next chancellor, potentially a sort of far-right Herbert Kickl, the head of the Freedom Party, he is not going to be on board with moving forward these sort of collective European projects. This is a Eurosceptic. There is also the question, of course, of Donald Trump, which makes things a lot more difficult from an economic standpoint. But I think the hope for many European leaders is that the pressure that Trump ramps up on the European continent will have to force to bring these states together in order to make collective action and to be a sort of collective, cohesive bloc in the face of what could be some very challenging few economic years versus Donald Trump.
Ollie, thanks so much. Oliver Crook there in Brussels. Now, Elon Musk is settling his sights on Europe, having successfully worked to get his candidate elected in the U.S. Now, the Tesla and SpaceX billionaire, who's set to lead an advisory body for the new Trump administration in Washington, has actually embraced misinformation and conspiracy theories while criticizing the governments of the UK and Germany. Let's bring in Bloomberg's Alan Crawford in Berlin. So, Alan, what's been the response in Berlin and London?
Well, governments have been really put on the back foot here. On the one hand, they're kind of silently outraged, but they have to be very careful what they say. They essentially are, it's very unclear in what capacity Musk is speaking. Is he speaking on behalf of Trump? It seems kind of unlikely. What does he actually want? Well, he's not making that very clear either. So governments are really treading on eggshells here.
So what's the impact? And actually, can he bring about change? Do people believe him? Does it change policy or thinking?
That seems extremely doubtful. Yes, in Germany, which has been one of the focuses here, he's been slamming the Chancellor as a fool, the President as a tyrant, and he's publicly endorsed the far-right anti-immigration Alternative for Germany party. Then there are elections here next month, but it's not really showing on the opinion polls. It's hard to really see how this might play out, apart from perhaps hurting his sales of Tesla. There's a big Tesla plant just outside Berlin here.
So why is he doing this, and what's the end game?
He's not making it clear, and he's being rather inconsistent in terms of the kind of forces that he's endorsing. As you saw a few days ago, he just broke with Nigel Farage of Reform UK. But the analysts that we spoke to were suggesting that they used the term that he tasted blood in terms of shifting his business clout into the political sphere. He, of course, backed Donald Trump with large sums of money, campaigned for him. It was ultimately successful, and so now he's training his sights on Europe to see essentially how far he can push the boundaries and test the European establishment, shake it up in a libertarian way.
Alan, thank you so much. Alan Crawford there in Berlin with the very latest on Elon Musk and, of course, European leaders. Now, some other stories making news. And we start with the sister of Sam Altman. She's accused the OpenAI chief executive of sexually abusing her for almost a decade. Now, in a lawsuit filed in federal court, and Altman alleges that her brother abused and manipulated her while they were growing up in Missouri in the late 1990s and early 2000s. Now, in a statement on behalf of himself, his mother and brothers, Sam Altman called the claims utterly untrue. An uncontrolled wildfire is threatening densely populated Santa Monica after ripping through an affluent area of Los Angeles. Now, the Palisades fire was at almost 3,000 acres, while two other blazes flared up overnight, one near Altadena and the other near Silmar, southeast of Santa Clarita. All are uncontained and have prompted evacuation orders. We're getting live pictures in, so of course we'll be following the story very, very closely. Up next, we talk about fixed income, new year, new bond issuance. Global credit markets have seen strong demand, with investors willing to settle for low-risk premiums. We discuss that next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
AI is going to reinvigorate the video game industry. On the one hand, for developers, it's going to reduce the cost of creating the content. On the other hand, all of the characters that are in the games are going to be smart characters in the future. So every time you interact with them, they're going to be interacting with you in a much more intelligent way.
Now, that's the NVIDIA chief executive, Jensen Huang, speaking with Bloomberg technology co-anchor Ed Ludlow. So borrowers are flooding global markets, debt markets at an unprecedented pace as they take advantage of demand for credit-hungry managers flush with cash. Now, for more on this, let's bring in Bloomberg's Valerie Teitel. So, Val, first of all, we'll talk about debt in general, because there could be a debt bubble that people need to worry about. But what's corporate debt looking like?
Look, there is a lot of appetite out there. It isn't, I guess, unusual that we see this big issuance boost in January. A lot of corporates try to fluff up their balance sheet with cash at the beginning of the year in order to sustain all their financial targets for the year. But what is unusual about this is there is voracious appetite from investors, while credit spreads are near 30-year tights. Some of the credit spreads are at historic tight levels. So it's very surprising to see this kind of appetite where there isn't much pickup over, let's say, holding a treasury, holding a government bond. Those really tight levels are still seeing appetite out there from the market. And a lot of that has to do, Fran, with just the fact that we're not very much worried about default risk anymore. If you think about this time last year, for example, we were still having worries about a U.S. recession causing perhaps a global economic downturn. We don't necessarily have those worries. So that default risk has really evaporated, I guess, on a global basis, so allowing these historically tight levels to get even tighter in the face of all the supply.
When you look at government debt, I mean, this is the huge, big concern. We just had a great conversation with PGIM and MUFG about the fact that a lot of this government debt, if you look at the policies that Donald Trump also wants to follow through, it's just a lot more issuance. A lot will come, for example, in the UK in January.
Yeah, that is definitely a global narrative of swelling budget deficits, these over-indebted governments. So it's a very different picture when it comes to government bond supply. So far this year, it's not been absorbed very well. We had the 10-year auction in the U.S. It had the largest coupon since 2007, the highest yielding coupon since 2007. And then we had a 30-year bond auction here in the UK, which didn't see very good appetite. So while we're seeing a good appetite for corporates, it's very much a different picture when it comes to governments. And frankly, it's because the balance sheet of governments is just not looking as healthy. If you take the UK, for example, tax receipts, which in some way are a measure of economic growth, they're not growing. But what is growing is the interest payments they're having to pay on their debt pile. We saw those 30-year yields yesterday hit highs they've not seen since 25 years. And the average maturity of the UK's debt pile is 15 years. So they're very much exposed to this steepening of curves. We've seen this global bond route that's been led by the long end. So frankly, government's balance sheets aren't looking as healthy as the U.S., which is driving that difference.
Valerie, thank you so much. Valerie Teitel there. Now, there are live pictures from Malibu, California, where an uncontrolled wildfire threatening densely populated Santa Monica after ripping through affluent areas of Los Angeles.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Good morning from our global headquarters in New York. I'm Manish Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
3 days of a bond market sell-off. Now the most bullish equity calls for 2025 face a new challenge. From Greenland to Mexico, President-elect Trump continues his relentless push for America First policy. And it's tech's big moment with CES in full swing, while Meta shifts strategy to a more friendly one to the incoming president. Good morning, Manus.
Danny, good morning. I want one of those chains, but we'll talk about the jewelry.
Look great on you.
From Mark Zuckerberg a little bit later on in the show. We've managed to turn it around. I mean, risk was interrupted yesterday. That is undeniable. NASDAQ was down 1.8%. It closed itself back. NVIDIA is now up 1.79%. But it was the rates market was the tail that wagged the global dog. You're right, Danny. The glide path to 6,700, 7,100 on these markets is now definitely interrupted. And we will go through a period of where is good news on the services side, bad news for the rates market. Roll it over. Ground zero for risk interruption. Strong data, an auction, which they had to cheapen up slightly. The $39 billion worth of 10-year paper had the highest yield at the auction since 2007. I don't want to go back to 2007. Bond yields dropped by a pip this morning. We wait for the 30-year bond auction. That better not be a shambles today. And dark matter, term premium, Danny. It's at the highest level since 2015. Dark matter, eh?
Wow, it's getting ominous this morning. Why don't we look at some stocks we're keeping our eyes on? Maybe something a little bit more joyful. Exxon. We're looking at Exxon this morning. Those shares are slightly higher, 1/3%. It's predicted a $700 million hit to its profit from lower oil prices.
Apple shares are moving as Indonesia has upheld its ban on the iPhone 16 due to the company's failure to meet local investment requirements.
And just wrapping things up with NVIDIA, a big decline yesterday. It is rebounding in the pre-market. Jensen Huang's product presentation, the kind of narrative from that was it left investors wanting more.
And in just a few moments, we'll put the bond market proposition to HSBC, Stephen Major. And a little bit later in the hour, we have Jack Janasiewicz of Netixis joining us.
And just to recap where you left off on the bond market, Manus, because it's been a global sell-off. 10's the highest since April 2024. 30's the highest since November 2023. For JGBs on the 30-year yield, highest since 2010. For the UK, 30-year yields highest since 1998. Joining us now, I'm pleased to say, is Stephen Major, Global Head of Fixed Income Research at HSBC. Stephen, back in November, your call for the bond market for 2025 was 3.5% for the 10-year yield. Since then, yields have moved the other way, higher by 40 basis points. This bond market has had a rethink. Have you had a rethink for the path for 2025?
Well, if you'd asked me what was happening in September when we hit 3.6, then 3.5 wouldn't have been so silly. So the fact is, Danny, in the space of a few months, we've had 100 basis points or so added on to 10-year yields. And I think the best explanation of that is a reappraisal of the Fed expectations. So we've gone from, say, 7 possible rate cuts 1 year forward to 2 or 3, whatever the number is. So that explains the shift in yields. Now, the interesting thing is that people are talking up the term premium. You said dark matter. I called it dark arts. I sometimes wonder whether, in fact, I wonder whether term premium was invented, the whole subject was invented by analysts to try and bamboozle their clients. Because, frankly, the explanation for the yield, Manus and Danny, is in the shift in rate expectations, not in the term premium. The term premium models that everyone will look at on the Bloomberg, the ACM, for example, is a model based on a regression that lags the actual move in the market. So I don't think there's much informational value in that. I think it's gone up, but it reflects where the market's already moved. And so, you know, really, the explanation for the yield shift is in the change in rate expectations. That's a very different proposition.
You've just wounded an entire group of people on the Federal Reserve, but I leave it for you to wound and insult them. I just enjoy the sport from the side. Stephen, good morning. You make it very clear the spike in yields is to do with rate expectations, not this narrative that we've been talking about, which is inflation. I mean, there's been a wholesale ransacking of the very long end of these curves. And everybody says to us, that's to do with inflation not being tamed and potentially resurging. You're nodding, you're disagreeing, you're nodding with me. Okay, you take it away.
I think there's a lot of polar opposites around. So it's the real yield that went up, not the inflation expectation, right? So look at the forward real yield compared to the inflation expectation. You're granted, Manus, I think it was the ISM expectation survey, which showed a spike recently, but that's a survey. I think the reality is the market has anchored those inflation expectations. The shift in the yield is on Fed expectations and in the real yield. When we're talking real yield, I suppose we're talking about real activity, GDP data, maybe fiscal policy, that kind of thing. But not, the inflation expectations, if they are there, the market is confident that the Fed will respond to dampen those expectations. So I think that there's this narrative out there that wants to be bearish bonds, but frankly, can you show me a bond bull? Because I can't see any around here. There aren't any in this place.
Apart from yourself.
And you know, well, I don't know. You maybe, but I'm not meeting many, Manus, in terms of our clients, and that probably tells you something. That has some informational value. Everyone seems to be the same way. They're talking up term premium, talking up inflation risk. Frankly, a lot of it's in the price. Look at the divergence between the US and the rest of the world. Look at the real yield shift. It just seems to me that something has to give. And it's quite interesting the equities are not living up to the expectations that many people had set for them at the start of the year. At some stage, that's going to feed into a more positive narrative on bonds if it continues.
Stephen, can I give you one more piece of the equation that the bears seem to say, and you can tell me why it's wrong? One of the theories goes like this, that as we know, Yellen's Treasury had been issuing a lot at the shorter end. There was a lot of criticism about that, whether rightly or wrongly, but Scott Besson has come in and said, okay, we're going to shift back to more longer-term issuance. And I know, Stephen, you have said so many times, which I think is so great, bonds are not potatoes. Supply and demand dynamics are different. But investors are front-running this idea that we will have more supply, and specifically that supply will be at the longer end, hence you have yields ramping up. Do you think there's any truth to that? And if there is, any sustainability to that move?
No, Danny, thank you. It's an interesting area to explore. So I think we said already that the yield shift is covered and explained by the shift in rate expectations, and it's not the term premium. I think that's the key point. Now, on the issuance, I think it's easy for us all to poke from the sides and say, look, they should have done this. looking back to the pandemic years when rates were close to zero, then they should have issued lots of long bonds then, shouldn't they? But they didn't. Other parts of the world, they did. Corporates did. Everyone termed out. So the US has put itself in a bit of a pickle there because they've got 25% of the free float in bills, and that's on the high end of their range. So they probably do have to start terming out at some point. Now, the thing is that it wouldn't be a good deal for the taxpayer to be terming out at 5% when they could roll at 4 to 4.5. So I think that there's a healthy tension here. We don't know where rates are going to be for sure, but I think it's an interesting incentive for the US authorities, and by authorities I mean Fed plus Treasury, to get rates down. Now, that may not be what people want to talk about because everyone's so conventional talking about inflation expectations and the inflation target and the Fed's mandate. But hang on a second, doesn't everyone know that they can't afford to keep refinancing at these rates? So to me, there is a sort of undercurrent, a subliminal message here. They need to get the policy rates down towards whatever neutral is, and the Fed guides a 3% longer run neutral at the moment. And they need to get there because they can't afford to be refinancing at 5. I mean, isn't that the reality? So it's a nice idea to term out, but I don't think they want to be doing that right now. It's not going to be a good deal for the taxpayer.
So you would look. Obviously, it's not, and the interest payments that they've got to make here in the United States of America is a huge portion and an issue for the deficit. Stephen, how can they justify lowering rates in 2025? What is the sequence of data that they need to restart the cuts?
Yeah, so I think that they've actually moved to a more cautious footing because they don't know what the policies are. And frankly, there's a great deal of uncertainty around what the future policy is going to be. So that they're waiting to see what happens. And maybe we'll have a clearer picture in the next 2 to 3 months. Now, the focus on the cyclical data says that they just need to wait, be cautious. But given time, I think that the reality is inflation is not a problem. I don't think it's going to be spiking. The inflation expectations are under control, and gradually, slowly, I think you're going to get more of a cooling of the labour market. There's a very narrow path, but they're trying to thread their way through this path towards the soft landing. The Fed is guiding to 3% for the longer run equilibrium. That says that the current policy is restrictive. So they still want to cut, but I think they're conservative. They don't want to be cutting when the economy is so strong and policy uncertainty is so great. So they're just biding their time. But I think the next move in rates is down, not up, and we'll have to wait for a couple more months. If you want the crux of this, Manus, is that bond investors are going to get good opportunities to buy through the first half of the year, and ultimately I think the yields will be back where they were a few months ago, which is 3.5 by the end of the year. But it's not going to happen all at once, and it wouldn't be a surprise if we're in a bit of a range for the next few months, and then the yields start to come down when we've got a bit more policy certainty.
Okay, so your call 3.5%. That's unchanged for the end of the year, Steve. In that range, do we get much higher from here in these sort of freakouts? I mean, what is that range that you're looking at?
So look, the forecast is an expected value. And what an expected value is an aggregation of all the plausible scenarios. So with a hard landing, yields could go to 2%. Now, that's not our baseline. Our baseline reflects a Fed that wants to get to a longer run equilibrium of 3% with a soft landing. Now, if the policy rate is unchanged for all of this year and most of next, but is coming down in 2027, if that was the scenario, then it's still difficult for yields to go above 5 on an expected value. And this is the point, is that the forecast shouldn't be a single path. The forecast should be a weighted average of the various plausible scenarios. And frankly, if bond yields are 4.6, they seem to be reflecting unchanged policy for this year and much of next. And that's why I think it's very unlikely you're going to get the 10s trading above 5%. And I think most investors are going to figure that out soon, that you're entering the buy zone. Other people have called it the danger zone. To be consistent, Something has to be consistent here. If the bond yield is dangerous for other asset classes, presumably it's also a buy zone for bonds.
You're on absolutely fine form this morning. You know, where others fear to tread, you step in and you want to buy. And we've got your floor. We've got your cap and your floor for 2025, which is 3.5 bid, 5 offered.
I love it. I feel like in one fell swoop, Stephen basically said to the entire sell side community, stop it with just the one call. Give us a scenario analysis. Stephen, I love it. That's great.
Steve, thank you very much. We'll see you very soon. We've got the cap and the floor. Well done, sir. Setting the agenda for 2025 on Bloomberg. Stephen Major there from HSBC. He'll be in town in a couple of weeks. Coming up, President-elect Trump makes some bold statements on foreign policy. More on the story next on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
We're going to be changing the name of the Gulf of Mexico to the Gulf of America. We need Greenland for national security purposes. People really don't even know if Denmark has any legal right to it. But if they do, they should give it up.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
You're talking about Panama and Greenland. No, I can't assure you. I think NATO should have 5%. Yeah, if you're going to have a country in a regular military, you're at 4%. I think they should be, they're in dangerous territory. I think it should be, they can all afford it, but they should be at 5%, not 2%.
That was President-elect Donald Trump speaking at Mar-a-Lago yesterday about his plans for when he re-enters the White House in less than 2 weeks. Joining us tonight to unpack what was a 70-minute presser is Bloomberg's EMEA News Director, Rosalind Matheson. Ros, let's start off with the potential. I mean, this is the art of ambiguity, isn't it? It's the perfect example of ambiguity by President-elect. But it's the threat of military force on Panama and Greenland. You're actually talking about the potential for using military force on a NATO ally. So is there any belief in the actuality of that, or does it say more about America First foreign policy 2025?
This says more really about Donald Trump's foreign policy as he comes into office again and his negotiating tactics. I mean, he was just refusing to rule out the use of military force or economic coercion was the question he was asked. And it's very unlikely to go to war over Greenland or even over the Panama Canal. But what he's doing is displaying his tactics, which is to make these very expansive comments, potentially threats, quite extreme sounding, and that then forces or encourages other countries to offer him concessions, to give him something to show that he can claim victory. So it's really about the negotiating tactics that he's likely to deploy once he's in office, led about the reality of him trying to do something like engage in military action over Greenland. So it's very, very unlikely that's going to happen. It's just his way of extracting concessions from countries, including Denmark, when it comes to a country like Greenland.
Roz, see, this I find interesting, because we could very well, like many of us did in the first Trump term, just end up chasing our tails and trying to figure out what is truth and what is just a negotiating tactic. What feels different this time, though, is the response of people listening to Trump and saying things. Denmark, for example, last time around when Trump talked about Greenland, said, is this an April Fool's joke? Called it absurd. This time around, the Danish prime minister did say, look, we will keep Greenland, it's not for sale, but then went on to say, it's in our interest that the U.S. is involved in our nation and not Russia, that the U.S. is the one that has the stronger presence. Is this a different Europe this time, a different reaction from all over the world and how to handle Trump and really appease him?
Well, having seen Trump in the first term, it probably is. It's about the idea maybe of taking him seriously, but not literally. So he's not going to invade Denmark again over Greenland or try and claim Greenland militarily, but he will be relentless. We can see that. He will keep coming, and maybe he will use tariffs and other economic penalties as a political lever. He's shown his willingness at least to do that. So to get ahead of it, what you need to do in a way is give him something or allow him something that he can claim as a win without ceding too much of your own ground yourself, because you've got your domestic imperatives to think of. So it's that balancing act of allowing him to have something to claim as the victory while not giving him everything that he's asking for. And that's certainly the lesson it seems that countries around the world, be they adversaries or allies alike, are learning.
Roz, thank you so much for joining us this morning. That is Bloomberg EMEA's news director, Roz Matheson. And we do have 2 weeks. Again, all of this is happening. 2 weeks until the president-elect takes office. Economies around the world are preparing for this recalibration of global trade and geopolitics. Here's what the European Commission Vice President told Bloomberg about the EU's plans.
We will have a plan to protect the steel sector from global overcapacity while ensuring competitiveness. I'm prepared to explore both defensive and offensive actions with my colleagues at the Commission. This is a dialogue that we will have at the Commission. I still hope to convince the next U.S. administration that we have everything to lose from a collective trade war.
Joining us now is Oliver Crook, who spoke with the commissioner there. Oliver, Europe has had some time to prepare for Trump, but this time is different. They have a weaker economy. They're still dealing with the war. They're dealing with the energy impacts of that. This time around, how is Europe getting prepared for 2 weeks away when Trump takes office and policy starts to come down the pike?
Yeah, I mean, listen, Danny, I think a lot of people are very reticent to give exact sort of ways in which they are preparing, because everyone is sort of putting on a brave face and say, oh, let's see what Trump will do. Oh, these are all negotiating tactics. I'm not sure that that is the sort of safest or the most prudent way to sort of approach this incoming presidency, right? And there are ways in which Europe is actually uniquely poorly positioned, particularly on the issue of tariffs, right? On the one hand, Trump wants to right the sort of goods trade imbalance. Europe exports a lot more to the United States than the United States does to Europe. That is something that Trump says he very specifically wants to target. So there's obviously the question of trade barriers going up between Europe and the United States at a time when the European economy is incredibly weak. But Europe also gets the bad end of the other side of this sort of trade dispute between China and the United States. Think about it. If the trade barriers go up between China and the United States, all that overcapacity comes flowing straight into Europe. That kills the industry here as well.
Ollie, thank you very much, Oliver Crook, on Europe's growing response to what is the next Trump presidency. I want to show you just some live pictures. This is obviously in the Palisades, on the Pacific Palisades neighborhood in Southern California. 30,000 residents have had to evacuate. These are live pictures of devastating loss across California as these wildfires burn out of control.
you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Let's get you up to speed with the front pages from around the world. This is what's making headlines. We just showed you some images there, but the New York Times leads with the devastating wildfires in Los Angeles. Parts of Santa Monica and Pasadena have been evacuated as the flames destroy homes along the coast. Over 220,000 are without power due to safety power cuts and wildfires.
Yeah, live pictures there of Malibu. Our thoughts go out to everyone dealing with that. Now, next up on Forbes, Ann Altman, the sister of OpenAI CEO Sam Altman, has filed a federal lawsuit accusing him of sexually abusing him her for several years. She alleged that the abuse happened from 1997 to 2006. The billionaire tech CEO and his family said the claims were untrue and that Ann faces mental health challenges. Okay, coming up, we're going to have more on economic data coming out this morning. We'll catch up with Natixis.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever. S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger and Manus Cranny here. Let's set your agenda.
3 days of a bond market sell-off. Now the most bullish of equity calls for 2025 face a new challenge. From Greenland to Mexico, President-elect Trump continues his relentless push for American-first foreign policy. And it's tech's big moment with CES in full swing and Meta shifting to strategy more friendly to the incoming president, to say the least. I want that chin.
Manus, Christmas is gone and past, and I didn't get you the chain. I'm sorry, it is too late. We'll have to wait for your birthday now. Well, here's a present for you. I'm going to steal some of your language, Manus, because I think it was right that this bond market was ground zero for the turmoil we saw yesterday. The sell-off takes a pause this morning, just below 4.7% on your 10-year yield. That is the highest in 9 months. Strong ISM jolts inflation break-evens, and the dollar rose. It is a market pricing in a hot economy, but that good news was bad news for the equity market, which fell more than 1% yesterday. Again, we take a breather this morning. NASDAQ futures lead the charge higher, up 0.4%. Your Russell 2000 little change, with an S&P just under 6,000, up 1/3%, Manus.
And there's NVIDIA for you, up 1.84%. Let's talk about the long end of the curve, Danny, because 30-year bonds is where there has been a ransacking, one could say, but perhaps not full vigilantism. Let's give you the stats. JGBs on the long end, the highest since 2010. The UK, the highest since 1998. And here in the United States of America, the highest long end on the bond curve since 2023. Jack Janasiewicz is a portfolio manager over at Natixis, and he writes this: looking at the inflation, simply put, the labor market continues to cool. The housing market shows plenty of disinflation still in the pipelines. So who's wrong? These bond traders on inflation, or is there another side to this market? Jack joins us now. Jack, we just had Stephen Major with us, and he said this spike in the bond yields is not to do with inflation. It is to do with a resetting of the rate-cutting narrative. You say that we should be a little bit calmer about the inflation narrative. Why? What's going to substantiate your inflation view 2025? Good morning.
Good morning. Yeah, and thanks for having me on. And I think those comments are pretty much, everything can work in tandem together there. But the bottom line for us, let's just take a step back and look at the big picture backdrop, right? For us to have an inflationary impulse, which would probably be the bigger negative here, especially for the equity market, I think you need to see a reacceleration in the labor market, and specifically on the labor front with wages. And all the ancillary data that we're paying attention to, we just don't see that right now. Everything is trending lower. And the second one, which is a fairly big line item in the core PCE or core PCI relative to the rest of the basket, it's that shelter component. And all the real-time data that we're paying attention to on the shelter component continues to trend lower. So take a step back. Those two big things are working in the right direction. We could get a few idiosyncratic blips along the way in here, which is what I think you might be seeing in the last inflation print. I'm not sure that's really enough to change the narrative in here and where I expect to see inflation reemerging.
Jack, it's an important point that the reason why bond yields go up are really the mechanism for why equities react. That if it's inflation, it's bad for equities. But at some point, at some level, does it not even matter? Because yesterday we saw strong economic data, we saw yields react off the back of that, and stocks sold off.
Yeah, and I think there is an imaginary line in the sand, so to speak. That 5% threshold on 10s probably does trigger some indigestion. But, I think the big takeaway here is simply that why are bond yields rising, right? If bond yields are rising because the growth prospects are looking better, that probably means something better for earnings per share expectations that's going to be a net positive for the equity market. But if earnings or if bond yields are rising because inflation expectations are moving higher, that's probably going to be a headwind for the equity market. So I think you also do need to distill why the bond yield is rising in here. And when we look at things like real yields and inflation break-evens, they're both drifting higher. For a while there, it was really more on the real yield front, which tells us a repricing of that growth expectation. But I think that's the key to pay attention in here into how that spills over into the equity markets.
And that's where you think that we're going to get some kind of, to paraphrase what other people are saying, an exuberant correction. You think there will be a growth scare? You think it'll come in the first half? What's the consequence of that for equities?
Yeah, and I think, given where we are from a valuation perspective, given that we've had 2 consecutive 20-plus years of equity market returns, when you look at the S&P 500, people, I think, are going to have somewhat of an itchy trigger figure in here. So it wouldn't be shocking if we sort of get some data in here that is enough to be a catalyst for them to say, hey, it's time for me to take some chips off the table. And that might actually produce that proper 10% correction, something that we haven't had in quite some time, quite frankly.
Jack, a lot of that uncertainty has prompted calls for gold, but I thought it was quite telling that Goldman Sachs just this week, who had been very bullish on gold, pulled back their forecasts and now expect gold prices to not hit $3,000 because of easing uncertainty. Does that uncertainty as to whether we get 2 cuts, 1 cut, or maybe none, reduce the attractiveness of golds in a portfolio right now?
That's a tricky one. I know there's always that cost of carry argument that people like to make with regard to gold and comparing that to the safe haven assets of, something like the treasury market in here. But if you are going to start to lump in a lot of the other uncertainties, things like, how are the deficit issues in the United States going to be addressed? What are we going to start to see from a supply perspective? Are we going to see it in coupon? Are we going to see it continued in the front end of the curve? Is inflation sticky? The list of uncertainties continues to go on and on. So I wouldn't be shocked if gold continues to still hold in here, especially as just simply a diversifying asset. I know we have a competing asset class now in cryptocurrency, so Bitcoin might steal a little bit of that thunder in here, but I certainly don't think it's time to completely abandon gold in here. And I think that there's still plenty of uncertainty still out there that warrant, that diversification within that portfolio.
Jack, one thematic of 2024 was the barbell approach from a number of people, particularly State Street, that wanted cash on the right-hand side and they wanted, or tech on the right-hand side and cash on the left-hand side. It was that barbell approach. I just wonder, as we go into 2025, do I supplant or enhance my tech on the right-hand side with top-ups like defense? You've got President-elect talking about defense spending at 5% now. Never mind your 2%, which a lot of people are struggling with. Now talking about 5%. So just talk me through your barbell and what that should look like for 2025.
I think you really can't give up on tech in here, right? Tech, I think, will continue to work, especially large cap tech, if rates remain elevated, right? I think the key for us is that 10-year yield needs to move back down closer to 4%, even maybe break through to really see that broadening out of that market breadth. And that breadth might be whether it's small and mid cap or even international. So we still think tech sort of acts as a defensive posture here, because if they're somewhat relatively immune when you look at those higher funding costs, those higher rates relative to the broader market, and I think you're still continuing to see massive growth in there, right? Earnings expectations for 2025, that growth rate, tech very, very strong, margin expansion still pushing higher. So can't abandon tech. And at the same side, I would also look at things like cyclical value for the other side of that barbell, simply because, as we talked about earlier, yeah, we do expect a growth scare, but that growth is simply going to be a scare. And we think, investors tend to overshoot to the downside. That'll give you your 10% correction. But I think on the other side, the economy's still going to hold up fairly well because there's going to be a floor in there, whether it's the Trump put or the Powell put. I think growth is still going to settle into the long-term averages, that soft landing, and that's why you still want to own that cyclical value source side of the equation in here.
Jack, your tech CEO wearing a $900,000 watch very blatantly doesn't concern you at all?
Again, it just goes back to that growth backdrop, right? At the end of the day, that's the big one.
I love it.
If
growth is better.
Maybe I'm wearing the chain too. I don't know. Maybe
I want the chain. I want the chain.
Oh boy, Jack, you and Manus can match. You both can get the chain. That's it. Things are doing well and plenty, so you can wear the chain, you can wear the watch. Jack, thank you so much for joining us this morning. Jack Janasiewicz of Natixis there with your style inspiration for the morning. Okay, coming up, we're going to unpack the incoming President Trump's blockbuster presser at Mar-a-Lago. Maybe some gold chains and watches. That's all coming up next on Your Brief.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
We're going to be changing the name of the Gulf of Mexico to the Gulf of America. We need Greenland for national security purposes. People really don't even know if Denmark has any legal right to it. But if they do, they should give it up.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
You're talking about Panama and Greenland. No, I can't assure you. I think NATO should have 5%. Yeah, if you're going to have a country in a regular military, you're at 4%. I think they should be, you know, they're in dangerous territory. I think it should be, they can all afford it, but they should be at 5%, not 2%.
President-elect Donald Trump at Mar-a-Lago and his foreign policy plans when he re-enters the White House in less than 2 weeks. Joining us now is Bloomberg's Enda Current in Washington, D.C. Enda, Trump is someone who had campaigned on a more isolationist policy, but what we got on that press conference are these revived threats of taking land from Denmark, Canada being absorbed into the U.S., changing the name of the Gulf of Mexico, and being really aggressive on Middle East foreign policy. How should we interpret it this time around?
Yeah, no question, Danny. Very sweeping, as you say, aggressive and unusual comments from the President-elect Trump about what he plans to do, not just territorial expansion, but also claims of or threats to levy heavy-duty tariffs on Denmark, a treaty ally, and of course then the threat to presumably ramp up violence in the Middle East in one way or another. So covering a lot of ground, it is unusual, but I think you know, a lot of economists and geopolitical analysts reacting to this make the point that yes, you don't quite know what's bluster and what's bluff, but ultimately you have to take what he's saying seriously. He does seem to have some designs on cutting, or at least pushing for some kind of negotiations with Greenland. He seems to be serious about criticism in terms of the influence of Russia and China on the Panama Canal, key trading route. And of course, we know full well he's talked a lot about tariffs and NATO spending when it comes to Europe for many, many years now. So yes, to be clear, it's unusual, it's confusing. We don't quite yet know how it's going to play out. But he's also consistently raising these issues as well. So we have to expect that something's going to happen during his administration.
Well, it's the kind of classic rhetoric, isn't it, that we became used to during the first Trump administration. One thing from John Hopkins, they talk about it as perhaps continentalism displacing globalism. Listen, there's also policy, and this weekend there's 20 GOP lawmakers heading to Florida to talk about tax. I think one of the lines is there's some salty people in this coalition. They want a reasonable adjustment. That was from one of the House members. They want a reasonable adjustment. What are they going to be lobbying for? What is a reasonable adjustment on salt that's going to get these 20 salty Republicans over the line? Nick LaLota, actually from Long Island, called them that.
Yeah, well, look, they are lobbying for increasing this cap on salt. Manus, to your point, I think the fact that the meeting is taking place in the first instance is seen as a positive, that this idea is back on the runway. I think when you consider that the Republicans have a majority, slim as it is, in the House, they can't obviously afford to lose votes on this, but they have that majority, and that President Trump himself has come around to reversing his initial policy decision on this, suggests that all of this is heading in the one direction. But let's not forget that this really is only one part of the broader massive tax discussions that are underway and will be underway towards what President Trump is talking about pushing through in one huge bill later this year. That's personal tax cuts, that's corporate tax cuts, that includes other individual measures, that includes this SALT measure as well. So the fact that these talks are happening in the first place suggests that there is policy traction. We don't yet know the details, Manus, but it does suggest there will be some kind of an outcome on it.
Okay, and let's see what kind of deal they come up with. That's Andy Curran of Bloomberg News on the latest from Washington. There's a growing list of executives paying a visit to the incoming president at his residence in Florida. Let's take a listen to the NVIDIA CEO Jensen Huang speaking to Bloomberg at the technology conference at CES.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him. And congratulate him and do everything we can to help this administration succeed.
It's a pilgrimage now for a lot of CEOs. Let's bring in Tom McKenzie. Tom, good to see you this morning. In terms of the CEOs, we've got a whole host of them traveling to Mar-a-Lago. This is about changing your board. This is about making your relationship with Donald Trump very, very clear. As we talk about CES this year, is that the dominant theme, is how to, as it were, Trump-proof your business or improve your rating opportunity from the technology world to the Trump world?
Well, you've seen that across a number of areas, haven't you? You've seen Jeff Bezos, of course, pulling that editorial that would have been in support of Kamala Harris. He's made a donation. Amazon's made a donation to the inaugural fund for Trump. You've seen the moves, pretty significant, of course, from Mark Zuckerberg, and we'll get the details on that in a minute, in terms of trying to appease the incoming President Trump. It's, to some extent, surprising that you have not had Jensen Huang at Mar-a-Lago already. It's surprising that he hasn't received that invite. That's what stood out to me from that comment, given the central role that NVIDIA plays within AI and, of course, the tech executives that Trump is surrounding himself with. Worth noting as well that Sam Altman, of course, within the AI world, has also made that $1 million donation to the inauguration fund. So this is a theme, you're right, in terms of what we're seeing from executives. They try to align their businesses to what they expect to be the policy agenda of incoming President Trump. A couple of other things that stood out in terms of Ed Ludlow's conversation with Jensen Huang was being pushed by Ed on what the commercial cases are for some of these futuristic policies or futuristic bets that Jensen is taking at NVIDIA on things like robotics, on things like autonomous vehicles, on things like their AI foundational model. And the inability to put a real dollar number on that seems to speak to the caution that we've seen, at least in the last 24 hours when it comes to the NVIDIA stock, not being able to close that gap. But he was insistent that the demand for data centers is still very strong.
I thought you were going to say the most important thing, Tom, was that I was indeed right. Now that we got that close-up interview, that he was wearing an alligator skin leather jacket.
So forward.
You're welcome, everybody. I mean, it's like the moment of everybody obsessing about fashion on tech executives. Everybody loved that story about Mark Zuckerberg's $900,000 watch. For me, I was like, rich guy buys an expensive watch, and we care why?
Well, they used to take a go at finance bros and their watches, you know, now it's tech bros. I want the chain. She can have the $900,000 watch.
That's a fair trade for me. I will absolutely take that.
But we don't know what the chain, I don't think the chain's worth $900,000.
Well, that's why I'll take the watch over the chain. But, I mean, Tom, just jokes aside, I mean, it is a new image of a Mark Zuckerberg. Oh, there's the watch. Okay, we're going to continue obsessing over it. Okay, so, I mean, it is a different Mark Zuckerberg, be it his image, be it the chain, be it the complete rethink of the company and how they do things like content moderation, which, by the way, let's be honest, things will still find their way to the internet, whether content is moderated or not by third parties. What does it say about this broader moment we're in?
I'm still stuck on that beautiful Swiss timepiece. They make 1 or 2 of these a year. We know that Manus gets one. We now know that Zuck gets the other. Look, yeah, this has been a pivotal change. It's not just the aesthetics for Mark Zuckerberg with the baggy T-shirts, the chain, and now that 900,000K watch. It's also the changes, of course, that will be central to Meta and to Facebook going forward, particularly in the US market. I mean, everything from putting Dana White onto the board, of course, that close Trump ally, to having that new policy chief in terms of the Republican background that individual has, to trying to reshape this company to align with Trump. The most significant, certainly symbolically, was what was announced yesterday, of course, in terms of, as you said, removing the external moderation. And by the way, more quietly as well, easing up on some of the policy constraints around the use of language that could, some would argue, lead to more aggressive, maybe hurtful language on the platform going forward. That is something that's been flagged as a risk. But this is an executive that's trying to mold the company back towards something that is more aligned with this incoming Trump administration. And what a pivot it has been. He's been called the enemy of the people. Trump called Zuck the enemy of the people, and he's threatened to put him into prison not that long ago. The pivot has been significant. He's dined with him now in Mar-a-Lago. He's made the changes to the board, and now he's made this significant change around what he describes as censorship. Others would say simple fact-checking.
Yeah, well, he chose Fox and Friends to actually deliver that message and discuss it. And we know that that is, of course, a favourite of President-elect Tom. Thank you very much. And for anybody that wants to get one of those watches, just they don't know what the brand is, it's Rubel Forcé. And there's only 2 or 3 a year, handmade. One day, Tom, one day.
I love this idea that there's so many people out there clamoring for a $900,000 watch.
You just need to go on Rich Go on Bloomberg, and you actually.
What, you think someone's going to be reselling that thing?
Well, I'm going to go on Rich Go now in a couple of minutes and have a
No,
little
Manus,
bit
we
of
already settled this. You're getting the chain. I'm getting the $900,000 watch. Okay, Manus, we're also keeping our eye on Albertsons this morning.
Market.
A different market, very different market. Albertsons will be reporting earnings before the bell. Let's go to Bloomberg's Dasha Afanasieva on this. Dasha, it's a different prospect for Albertsons. Last earnings, they were saying we're confident that this Kroger deal will be done, and maybe that helped to kind of assuage some of the investors and not that great of a set of earnings. What happens this time around when the deal has been denied?
Yeah, and I mean, looking at the share price, there was a pretty strong, the market certainly believed that the deal wouldn't go ahead. So the CEO, Vivek Sankaran, has had plenty of time to think of the alternative. And I think investors really want to see a plan for medium-term growth, which means a savvy digital strategy, the progress on its loyalty scheme, more than there has been already, and of course the standard putting shops in the right places, having low inventories. Meanwhile, the company is also suing Kroger over the deal, so it's quite difficult to sort of totally kind of draw a line under things, you know, and appease shareholders who didn't get their massive payout, whilst also, you know, moving forward with this lawsuit. And of course, it's tricky for both sides because they both have to argue to investors that now will be completely fine alone, having told competition regulators that they're actually going to be more of a strong power to challenge Walmart. But it's harder for Albertsons because it's smaller and because it's sort of been caught on the back foot. And I think the CEO's been around for almost 6 years, and he's going to have a tough time convincing investors that it's plain sailing.
Tough defense strategy. Dasha, thank you very much. Dasha Afanasieva there on the very latest on Albertsons. We're going to set you up for your trading day, 30-year auction coming up. We'll give you the details in just a moment. Good morning from New York.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Let's get you set up for your trading day on this Wednesday. Jobs data on deck. ADP comes at 8:15 a.m. Eastern. Jobless claims comes one day earlier than usual at 8:30 a.m. Then 30-year Treasury bonds go on auction this afternoon. And finally, we're going to get the Fed minutes, Manus. Those come out at 2 p.m.
Yep, a lot to chew on, Danny. That is that $22 billion worth of 30-year paper. By the way, the long end of the yield curve, Stephen Major has been with us this morning. He said this ransacking at the long end of the curve is to do with real rates, Danny, and the drop in the expectation for Fed cuts, not the inflation narrative.
But perhaps it's different elsewhere, where the fiscal headroom is really thin. You're looking at UK bonds there, the highest since 1998 for the 30-year yield. For Japan, the highest since 2010. That's it for your brief. Surveillance will take things from here.
Institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, the people at Harvard, I'd like to know who the students are behind these clubs so I make sure I don't inadvertently hire them. And so I tweeted out that, sort of made that point, and caused a bit of a firestorm, and I got a lot of pushback. Oh, why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Our base case is for volatility, episodic volatility.
Primary trend is up, but it's going to be delicate. There's going to be some things that are likely broken.
That top 20% of momentum is now starting to just be a little broader.
I worry about a 10 to 20% drawdown this year if inflation does, in fact, look like it's being sticky or moving up.
I don't know that I look at 2025 and see another 20-odd% return in the equity market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now as we come into Wednesday following yesterday's losses. Equity futures looking for a little bit of a bounce here on the S&P 500 higher by 0.3%. On the Nasdaq 100 up by 0.4%. Firmly in the driving seat, this screen right here is the US bond market. Check out 10s and have a little look at 30s. We are getting closer and closer to 5% following some surprise economic data yesterday. It was the prices component of the ISM, spooking investors just a little bit. Going into more data later, we're going to get the ADP jobs report. You'll get jobless claims as well before the big one on Friday. It's Payrolls Friday.
When you talk about the prices paid component, it came in at the highest level from the ISM services report going back to February of 2023. People looking at this in tandem with the upside beat to the job openings data that jolts the headline figure. Some people saying, look, another sign, what do you need of the fact that there is more momentum in this economy? At the same time, for every positive data point, there was an equal and opposite aspect of that data that you could point to if you wanted to be bearish.
Big question for the nation's capital as we get closer and closer to 5% across the yield curve. Just how much debt can this bond market absorb? A little bit later on today, reportedly, President-elect Donald Trump heading to Capitol Hill.
He's going to be heading to Capitol Hill, sitting down with Republicans now. What is so interesting about this is that debate of whether or not we're going to get one big, beautiful, powerful bill, or maybe two less powerful but big bills, is still happening right now on Capitol Hill. Wall Street Journal editorial board this morning says, will the real Republican legislative strategy please stand up? And what might matter to this bond market is that clarity. Potentially we'll get some more of that today.
Yeah, how much clarity did you get yesterday in the news conference in Mar-a-Lago from President-elect Donald Trump? Here were the greatest hits. Renaming the Gulf of Mexico, compelling Canada to become the 51st state. There's more. Persuading Denmark to give up Greenland and taking control of the Panama Canal. Quite a news conference yesterday.
It was quite a news conference that threw out a lot of things, but this is what Donald Trump does. He basically takes things where there's a nugget of strategic importance and he puts it in a way that defies the norms of strategic alliances of the past. And basically there is a question here of how much markets have become benumbed to some of the ways that he discusses these things at a time when otherwise, honestly, some people have said, look, Greenland does actually have a strategic benefit to the United States.
It absolutely does, and so does the Panama Canal. What you have to think about when you think about the President-elect Donald Trump is maybe not take everything literally, but take him seriously. And if you take him seriously on what he is talking about, is he clearly wants a level of a sphere of influence back for the United States when it comes to national security and economic security concerns. A lot of people, this unnerved yesterday, but this is going to be what I think he calls a great realignment. This is a man who talks a lot about isolationism, but yesterday there's a lot of imperialistic language.
I feel like we have to say this on repeat. President Joe Biden, still the president. Inauguration, January 20th. Got quite a year ahead of us, that's for sure. Equity futures right now on the S&P positive by 0.3%. We've talked about the bond market a little bit. In foreign exchange, the euro trading through 103 last week, very briefly with a 102 handle. We're threatening to do the same all over again. Getting closer. We're down 0.2%. Euro dollar 103. 18. Joining us this hour, we'll catch up with Russ Kostrick of BlackRock on the latest bond market breakdown. We'll catch up with Adam Posen of the Peterson Institute on Trump's latest threats, and Andrew Hottenhorst of Citi looking ahead to payrolls. We begin this hour with stocks bouncing back following a sell-off fueled by losses in the bond market. Russ Kostrick of BlackRock is cautious, writing, "We remain modestly overweight equities but have reduced the magnitude of the position. We expect more volatility as the markets digest uncertainty over the Fed outlook, tariff policy, and the headwind from higher long-term yields." Russ joins us now for more. Russ, welcome to the program, sir. Just how strong is that headwind from this bond market this morning?
Well, good morning, Jonathan. I think it depends on how far you think yields are going to go. 470 on the bond market with a strong economy and decent earnings growth, it's not the end of the world. The equity market can move higher, but obviously people are worried about more of a melt-up in rates. That's not our base case scenario, but clearly we're in an environment where both because of the stickiness of inflation, because of concerns about supply, because of concerns about tariffs, it's going to be a bumpier road, and we are going to see the potential for yields to be in a higher range than we had previously.
Russ, how much has changed since 3 weeks ago? And I guess this is a key question as to why are the bond vigilantes coming out now?
I don't think that much has changed. As you pointed out, there was one part of the service component on the ISM that was a bit higher. We know inflation on the service side is sticky. We know that this part of the inflation picture is less susceptible to Fed monetary policy. So I don't think that number told us anything we don't already know. But clearly the bond market is on edge. This is not just about inflation. It's also about supply. So again, I think we have to be prepared for an environment where bond yields are not necessarily quickly reverting to a level that would make the stock market comfortable.
At this point, Russ, you're not particularly optimistic, at least not as optimistic when it comes to stocks as you had been. You're still underweight duration. So what are you actually owning?
Well, we are overweight stocks, and we should be very clear about that. We maintained our overweight throughout last year into this year. We still think stocks can go higher, particularly in the U.S. And the reason for that is, again, if yields are trading, call it, very broadly, a 4 to 5% range on the 10-year, but you have that in the context of strong nominal GDP. You have an environment where earnings can grow once again in double digits. That's an environment where I do think stocks can go higher. Now, again, you've got to pick your spots. We still think there's room for some of the secular growth companies. We still think consumer companies are very well set up. Financials can go higher. So it's not an environment where I would pull back from the equity market, but I would moderate that overweight.
When it comes to other positioning like gold, you say you have a modest position. Is that something you actually would want to add to? We have seen even central banks this week adding to that gold position, like China.
You're exactly right, Anne-Marie. And I think we would. It's a position that, gold is, you've got to calibrate the right amount. It is an asset class with no cash flow. It can be volatile, but we do see a benefit in the portfolio in this environment. And you think about, what are the risks? Well, clearly, inflation's still a bit of a risk. What Fed policy is going to look like is a bit of a risk. But the other one, which I think has been impacting the long end of the curve, is the fiscal situation. These large deficits that don't appear to go away anytime soon. In that environment, the question becomes, what can you own that governments can't print more of? Gold is a scarce asset, and is that scarcity, coupled with the fact that a number of central banks, including in China, have been adding to their positions, that I think makes it attractive in small amounts in a portfolio over the longer term.
When you think about the fiscal outlook, does it matter to you, or do you think it matters to the bond market that everyone is starting to think has now a potential vote, whether or not there's one big bill, a reconciliation bill with a ton of spending that goes across tax cuts to immigration, or do you think it'd be better to see this slow drip feed of the potential fiscal spending?
I'm not sure there is a huge preference in the market about how this gets done. Obviously, the longer the fiscal is unresolved, the more uncertainty, the more potential for volatility. But I think the bigger issue for the bond market really comes down to supply. Whether you do this in one bill or two, are you going to add substantially to the deficit? Or are you going to add substantially to supply? Because, again, it's worth going back and remembering what's been happening in the bond market. This has been a fairly substantial curve steepening. And part of that is really about the question of supply, how much the bond market can absorb. And that's where I think investors are really going to be paying attention. What is the net add to the deficit over the long term?
Russ, I think it's a bigger question. When you say things like how much can the bond market absorb, I think which bond market? The US bond market, the global bond market, the UK bond market. I was really interested to see how the price action played out yesterday. If you looked at the economic data come out, we got the ISM, and then you saw the bond yield move. But we saw bigger moves elsewhere in places like the UK, and gilt yields are up again today. And I just wonder, from your perspective, how much crowding out you're expecting, how much pressure we could see on markets elsewhere.
Well, I think that's a totally fair question. As you point out, again, the long end of the UK bond market, also a very big move. And part of what's going on here is, one, there's the crowding out effect, but there's also the reality that this is not just a U.S. phenomenon. In some ways, the U.S. has seen more fiscal deterioration than a number of other countries, but in general, we've seen overall developed market debt rising, and clearly we're not the only country that has a spending and a debt problem in the long term.
So, Russ, how do you think that plays out in foreign exchange with all of that in mind?
So, it's funny. We still have a little bit of a long dollar bias. I think there's a lot of question about the dollar over the long term, and that's reasonable. But if you think about where we're at, where we're once again in a situation where it's unclear how fast or how much the Fed's going to cut, and you have a strong U.S. economy, and you have the potential for more stimulus, I do think that in the near term, the dollar can hold in, and particularly against some of the other currencies where you're not seeing the same type of growth that you are in the United States.
Russ, before we let you go, you were talking about how you're underweight duration, you're still overweight stocks. That does seem like the better bet. If yields continue to rise, at what point does that switch? Do you go overweight duration and underweight equity risk, considering just the valuation proposition?
I think that's fair. I don't know if there's a magic number. I know everyone is very focused on 5%, and that number is going to keep coming up. It's a nice round number. I don't think you completely shift your allocation. Clearly, if you see a further backup in rates, I do think you get to a point where it starts to become more attractive. But what I would say is that the near-term overweight to equities is really grounded in the environment, in the regime we're in. And that is an environment where, while valuations are not cheap, in the near term, you have a world where earnings growth is likely to hold up. You're still seeing a lot of innovation by U.S. companies, and I do think that still leans towards an overweight to equities as long as yields don't melt up too much.
Hey, Russ, good to hear from you. Thank you, sir. Russ Kostrick there of BlackRock. Should you wait for yields to get to 5 before you buy? Steve Whiting of Citi saying 5 would be something that we would think would be really appealing. This came from Evan Brown of UBS. U.S. Treasuries are now attractive. Expectations on growth and inflation are no longer clearly skewed to the upside. We're on the bond market a little bit later. Equity futures right now on the S&P firmer by about 1/3 of 1%, with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A fast-moving wildfire has ripped through an affluent area of Los Angeles, destroying homes and forcing thousands of people to evacuate. About 30,000 people were ordered to leave their homes after a brush fire erupted in the Pacific Palisades community, causing panic and traffic gridlock. The blaze has spread to almost 3,000 acres and remains uncontained. The Biden administration is shifting more than $100 million in military aid from Israel and Egypt to Lebanon as it tries to bolster the ceasefire agreement with Hezbollah. The Associated Press reported that most of the money will go to the Lebanese armed forces to help them deploy in the south of the country and supplement the UN peacekeeping mission. Tencent has repurchased 3.93 million Hong Kong-listed shares on Tuesday. That's its biggest buyback in nearly 2 decades, following a Monday sell-off, which was sparked by the tech firm's addition to a U.S. blacklist for alleged links to Chinese military. Tencent has denied the allegations and said it will work with the Department of Defense to address any misunderstanding. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Trump's big plans.
We're going to be changing the name of the Gulf of Mexico to the Gulf of America. We need Greenland for national security purposes. Canada and the United States, that would really be something. You get rid of that artificially drawn line, and it would also be much better for national security.
That was quite a news conference from New York City. That's next. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Live from New York City, looking to bounce back from yesterday's losses. We're positive by 0.3% on the S&P 500. In the bond market, little changed. A bond yield near 470, 468, 71. Under surveillance this morning, Trump's big plans.
We're going to be changing the name of the Gulf of Mexico to the Gulf of America. We need Greenland for national security purposes. People really don't even know if Denmark has any legal right to it. But if they do, they should give it up.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
No, I can't assure you. Canada and the United States, that would really be something. You get rid of that artificially drawn line, and it would also be much better for national security.
So here's the latest, and I'm not sure where to start and where to finish. President-elect Donald Trump taking aim at Panama, at Greenland, and Canada in a wide-ranging news conference from Mar-a-Lago. Trump threatening more tariffs and refusing to rule out using military power to expand U.S. influence. Bloomberg's Tyler Kendall joins us now from the nation's capital. Tyler, what was the reaction to that news conference?
Yeah, good morning, John. So President-elect Trump used that news conference to try to shape what would be expansionist policy and frame it as potentially good for U.S. domestic policy. We repeatedly heard him hit on three themes there: national security, economic security, but also a competition with China. Look at just Greenland, for example. We know that it is strategically located in the Arctic for U.S. and NATO allies when it comes to countering Russia amid the war in Ukraine, but it's also home to the third largest oil reserves in the Arctic and is also considered to be rich in critical earth minerals, something, as you know, the U.S. has been trying to shore up in its competition with China, particularly as we try to boost our own domestic supply chains when it comes to semiconductors. Now, something in common in all of these places is that leaders of these foreign lands have said that they are absolutely not for sale and have publicly criticized these plans from Trump. In terms of where we go from here, Trump, of course, has been ratcheting up his tariff threats, but it's unclear exactly what those would look like, particularly in these places. You heard him there threaten potential military action when it comes to Greenland and the Panama Canal. In terms of that, he would likely need some sort of buy-in when it comes to Congress.
Tyler, appreciate the update. We'll catch up with you soon. Tyler Kendall there, down in Washington, D.C. The geostrategic importance of Greenland, I don't think that conversation is going away anytime soon. Making Canada the 51st state feels like a little bit of a stretch.
That one feels like a stretch, but there might be economic coercion in the sense that he is serious when it comes to tariffs, when it comes to someplace like Canada. I will just say on Greenland, I covered Russia for a number of years. The Arctic is so important to Russia. I couldn't go through a single conversation talking about shipping, talking about oil and gas, critical materials, without a Russian official bringing up how important the Arctic was to them.
The incoming president well aware of that fact, that's for sure. Let's attempt to continue this conversation with Adam Poston of the Peterson Institute for International Economics. Adam, welcome to the program. There is a chairman, Jay Powell, who's got to set policy for upcoming policy changes from the incoming administration. Adam, you've warned multiple times that there is a real risk of re-accelerating inflation and perhaps even a Federal Reserve that has to hike interest rates. What did you make of the news conference with Chairman Powell to close out 24, and what would you expect to see in early 25?
Thanks for having me back on surveillance, John. I think the horrifying aspect of the U.S. threatening, even in the vaguest terms, military action against peaceful democracies to grab land is beyond offensive and irresponsible, and we can't sane wash it. There's just no excuse for the U.S. doing that. The prosperity and peace of the world for 80 years has come from the U.S. saying, no, you can't adjust borders through military action. Anyway, on the Fed, if we assume that that was bluster, the inflation risk is there, and it's not just because of the likely Trump policies, although it's primarily going to come from the tax cuts that are online with whatever additions are made that are just going to extend at a minimum the previous tax cuts under the Trump and the Republican Congress, which will at a minimum raise the deficit by around 1.5% of GDP a year going forward. Tariffs are inflationary unless you do them so big that they cause a recession. Declining migration, deportations are inflationary unless you do them so big, unless you cause a recession. So again, even if we assume the moderate middle version of the Trump administration proposals, it's an inflationary situation. And yeah, Powell and the Fed should have seen this coming. They, as I said before Jackson Hole last summer when I saw some of you out there, they should have said, you know, loose fiscal, bad trade, bad migration is inflationary. And also they should have recognized that they got it wrong on the labor markets in the U.S. They were much more resilient than they thought. That was already clear by last summer. It was already clear by last summer that they had not tightened financial conditions anywhere near as much as they thought. So there's a bunch of reasons I expect the Fed to be announcing in March, April that the bias is neutral to tightening, and I expect them to be tightening once the budget goes through by summer.
So, Adam, are you basically seeing a Fed that can hike after we get these the proposals that Trump is talking about be put down in legislation?
I think, Anne-Marie, that is what's going to happen. And I think it's very interesting, and as expected, frankly, that they were able to push the vice chair of supervision, the step down as vice chair of supervision, but not get Michael Barr to leave the role of a Fed governor, which is entirely legal and right. And it's good he still wants to serve. And that means you've got a very independent board of governors. You've got inherently independent Federal Reserve Bank president. So even though I think the Fed got it wrong, I don't think they're fundamentally wrong-headed. They're going to face this. What is going to happen, and is already happening, is they're going to be behind the curve, because for political reasons at this point, since they didn't get ahead when it was both Harris and Trump talking inflationary policies, the Harrises were less. Since they didn't get ahead of it, they're going to be slow to react. And that's going to lead to more inflation momentum. Is it going to be impossible for them to get it down? No, but it's going to require hikes starting in the second half of next year.
Adam, what is your base case, especially based off the conversations you're having? Trump came out and said that to get his one big, beautiful, powerful bill through, he's going to have to use those tariffs to offset when it comes to adding to deficit concerns. At the same time, the Washington Post had a report that talked about more critical, narrow, targeted tariffs. Do you have a working assumption at this point?
I think it's roughly 60% likely that they will stick with the negotiable tariffs and give up, make claims about the revenue, but give up having reliable tax revenue that can be used in the congressional scoring. I think there is a combination of too much desire from the president-elect, from the Commerce Department, USTR, and even state to do these kinds of leaning on, is it Denmark, is it Panama, is it Canada, as well as Mexico and China, and a little bit too much rationality from the economists in the administration that if you do across-the-board tariffs, you get revenues, but you also get inflation. I still think, though, that I'm worried, say there's a 25% chance, which is worth worrying about, that they're going to push for what they tried to push for 8 years ago, which is a DIDCUFT, destination-based cash flow tax, which is essentially a VAT, a sales tax, but with added bias against imports and pro-exports. And if they do that, then they can put 10% across the board tariff and say they're replacing corporate taxes with that. And then you do get not enough to cover the loss of corporate taxes, but you get 1.5% of GDP a year on a 10% across the board tax, order of magnitude. And they can use that in negotiations. So I think there's a chance. Kevin Hassett's a big advocate of the DBCFT. I think there's a chance they'll try to do that and buy Trump off that way. But my base case is that they can't risk the inflation. They don't want to give up on the bilateral bullying for so-called national security reasons. And so they stick with the really tough on on China and Mexico, go after a couple industries like pharmaceuticals and autos, and then spotty tariffs beyond that.
They might go hard on Canada as well, actually, Adam. We have no idea. But I do wonder going forward, one of the big discussions right now is where we are, not just what will happen under some of these new administration's policies. Do you have a sense of where neutral is right now and how much higher or lower it is than what some people are assuming, including the Fed?
Lisa, again, I'm sorry to keep harping on this, but this has been a discussion that's been out there for a couple of years. I hosted an event at Peterson where we had Larry Summers and Olivier Blanchard 2 years ago talking about the rise in our star, and I've been arguing for over a year and a half. Our star is probably 100 to 150 basis points higher than what the Fed's been treating it as. This is because we've got ongoing fiscal deficits that have risen in the midst of full employment. This is because we've got a good increase, productivity growth trend. This is because we have financial markets now that transmit monetary policy much less dependably. This is because risk has come back in the economy in terms of tolerance versus COVID. And this is because you're getting less inflow of savings from around the world, particularly from China and non-China Asia into the U.S.
And you've warned about it for a while, repeatedly, Adam, and credit to you. Adam Posen there at the Peterson Institute. From New York City this morning, good morning.
Is the Vivian Tom clientele? Yeah, power women, like the dragon, dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, they feel that the power, the energy. So now they come back to the store and they buy more.
It's the countdown to to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
A volatile start to 2025. Equity futures right now on the S&P 500 positive by 0.1%. Looking to bounce back from yesterday's losses. The Nasdaq 100 up by 0.1. This coming from Barclays. Resilient earnings and growth-focused central banks remain broadly in place for equities to climb the wall of worry. The wall of worry getting a few bricks in the last 24 hours. Let's turn to the bond market. One of those bricks coming from the ISM services data in America yesterday. Sounds a little bit niche, but ultimately it's about the prices paid component of the ISM. Surprise to the upside. And I think really spooking this bond market as well in yesterday's session, Lisa. Yields up again this morning, approaching 470 on 10s.
Yeah, and it came with a higher than expected ISM services headline number. So the idea of both more robust activity and an inflationary impulse underneath it really spooking people. At the same time, the employment component, if you want to get really niche, of the ISM services figure actually declined from the November read. You can look under the hood and still find what you want to find. At the same time, the headline data keeps coming in, just hotter than people really want to see.
We said this on this program about 25 minutes ago. Don't just look at the US bond market. Look at what is happening elsewhere. In the United Kingdom, the 10-year yield higher by something like 9 basis points on the session, the highest since October 2008. When we start thinking about testing the limits of fiscal space in America, I think we're already doing it elsewhere. You've seen this play out in a pretty vicious way in the United Kingdom.
Well, the United Kingdom is the poster child of it. They're the creator of the Liz Truss moment that is being hung over the heads of all sorts of bond vigilantes around the world, and frankly, government officials that are grappling with a lot of deficit spending. A real question here, and you asked it earlier to Russ Kostrich, how much does higher U.S. yields suck the oxygen out of the room for other countries that don't have the same kind of fiscal dominance that the U.S. and its dollar seem to have?
Bond yields up, dollar stronger. Check this out. Euro dollar, it's a break of 103 again. It's 102.97. We're down on the session by 0.4%. Dollar strength making a comeback on a session this morning with bond yields pushing higher.
And this really goes to the idea that people are pushing back how soon they think the Fed can really cut rates. It has to do with the fact that given the inflationary impulse and some of the better than expected data, now the first rate cut of 2025 could come in July rather than June. That's according to market pricing. And it comes as, where else are you going to go? And that really is what's hanging over this market.
Gold or Bitcoin.
Yeah, exactly.
There aren't that many alternatives outside of the US dollar. Under surveillance this morning, President-elect Donald Trump escalating threats against Canada, against Greenland and Panama, refusing to rule out using military or economic coercion to expand US influence over the countries, including imposing high-level tariffs on Denmark to persuade it to give up Greenland.
So let's talk about Greenland, right? Because I think that's what everyone is focused on. One, the U.S. already has a base there. The U.S. military has a home base in Greenland where we use it to detect missile threats and monitoring space. So there's already a cooperation there. So I have to think, Mr. President, why do you feel the need to take control of it if you pretty much are controlling the military aspects of it? Maybe you want to get some of those more raw materials. Maybe there's a deal to be had. What struck me is the more conciliatory tone we heard from Denmark. You know, back in 2019 when Trump first said this, it was, this is absurd. Now it's, we're very excited that the incoming president has taken a liking to Greenland.
Basically, this really shows how much people understand the rhetoric versus the intent and how to handle Donald Trump. And I think that a lot of this is really coming, highlighting how different it is now than 2016 when people were shocked and clutching their pearls at the idea that a U.S. president would be having this sort of autocratic speech. Now it's, okay, it's a negotiating tool. We need to basically have some nice talk and then we can come to some sort of deal. It's a starting point. And that's how it's being treated on the global stage. And I think that that's sort of an interesting departure.
It leads me to wonder whether they're seriously underestimating the extent to which the incoming administration wants a serious realignment across several dimensions worldwide.
President-elect Trump said it yesterday. We want a realignment when it comes to economic security and national security. And that is why he is honing in on these issues. And that is why he continuously comes back to this idea of tariffs and trade, because he thinks the U.S. is not getting a fair shot.
Let's turn to this story from NVIDIA. The CEO, Jensen Huang, telling Bloomberg's Ed Ludlow he hasn't been invited to visit President-elect Donald Trump at Mar-a-Lago just yet, but he's ready to meet him.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
He's basically the last major tech CEO that hasn't been down to Mar-a-Lago to meet with the president-elect.
Right, when Ed asked that, I was thinking there's no way he hasn't been down yet to Mar-a-Lago, but he hasn't. Maybe one potential word of advice to the CEO is you just show up, maybe don't wait for an invitation, go there and say, I'd like to speak to the President of the United States. It was the follow-up that Ed asked about tariffs I thought was very interesting. He gave a very diplomatic answer saying, we are happy to work with the administration and give them, quote, as much insight as we can from our perspective. Of course, remember, NVIDIA at this moment is already facing a ton of restriction when it comes to the most advanced, expensive chips when they want to sell into China.
Which is why I thought it was so interesting that he said that he welcomes that this president seems to want less regulation, and that they think the light touch will allow them to move fast because we have to move fast. Those are his words. I just wonder whether that really applies to the tech sector.
Move fast and get back to the office is the message coming from JP Morgan, planning to bring back staff into the office 5 days a week. Sources telling Bloomberg the bank is set to announce the change in coming weeks, replacing an existing 3-day mandate for many of its workers. The move marking a return to pre-pandemic expectations. And I have to say, things that don't usually happen when labor markets are super, super tight.
That, I think, is really the takeaway, which is that a lot of companies are saying get back to work because they can. People can't say, well, I'm just going to leave and go to another company that will allow me to be there, because they don't have the same kind of job openings. I will just say about 60% of the staff already do come in 5 days a week. This is everybody else, and the fact that they're not worried about losing them, to me, I think is the right takeaway for
The employer taking back some leverage.
Well, what I found so interesting is why now? In the fall of last year, Jamie Dimon was in Washington, D.C., and he was chastising D.C. federal workers, saying Washington, D.C. needs to get back to work. Goldman, I think, had a full-on office, full-time in office in 2021, and then reiterated and reminded their employees of it in 2023. So why is it taking J.P. Morgan till 2025 when we know the culture at the top, the CEO is, you should all be at your desk?
So let's park JP Morgan and let's talk more broadly about corporate culture in America right now. I think the CEO and corporate culture and the space between them is getting wider and wider and wider, and has done for much of the last decade.
There's two CEOs.
Human resources.
Exactly.
The head of the HR department in many of these companies have become incredibly powerful over the last several years across the whole host of different topics.
To me, this is the question of how do you maintain corporate culture with a large company, and that's something that's being reassessed. I'm not an HR specialist, but I do think that this is something that's increasingly at issue with the sort of get back to office, but also more than that, what is corporate culture, and sort of how do you imbue that throughout the ranks?
Pick a company, any company in America. Listen to an interview with the CEO, an old school CEO who's been around the company for a long time, and listen to them talk about corporate culture. Then go speak to some people who work there and get an understanding for how things are actually functioning and how much human resources have changed the operations over the last few years. And you'll get two very different views of what corporate culture is.
Well, you talk about the size of the company, and the bigger the company, the more that's true.
Yeah.
The smaller the company, the more you can kind of create that. Honestly, it's a bigger discussion about a lot of companies, and I don't think we have time to really wade into it right now.
No doubt we'll have that conversation later this year all over again. Let's turn to big tech. Meta announcing major changes to its platforms, impacting hundreds of millions of US users with a focus on free speech. The company dropping third-party fact-checking and overhauling its content moderation. Stefan Slowinski of BNP Paribas Exane writing, we view the moves as a complex political gamble with potential for near-term payback, but also medium-term risk, which investors need to weigh up. Stefan joins us now for more. Stefan, welcome to the show. I want to start with this. So they're stripping out liberal political influence, and it may well insulate them from the regulatory impulse of the GOP. Do you think they believe this will help user engagement? Do they think it will lead to a rethink on things like TikTok from the incoming administration? How do you think about this shift from Meta?
Yeah, good morning, Jonathan. Thanks for having me on. So I think as investors, we need to look at this through a framework of what will advertisers think, what will users think, and what will governments and regulators think. Obviously, advertisers maybe being the most important, as they're what drives the revenues for Meta. And the risk here is advertisers may fear that Meta becomes Twitter 2.0. You know, will we see increased content that is not to the liking of brand safety for those advertisers? Twitter has reportedly seen revenues fall from more than $4 billion in 2022 to just around $3 billion last year. So I guess that's the risk, is advertisers worry about brand safety, and as investors, that could impact the top line for Meta medium term. As you point out, near term, there potentially could be some upside if this helps decisions around TikTok move in Meta's favor. On the 10th, so on Friday, TikTok is going to be pitching the Supreme Court to put off the ban in the U.S. That's supposed to come into place on the 19th of January. So that's a really near-term event that Meta could stand to benefit from.
Stefan, I'm wondering if you can go back to 2016, when Meta first put into effect that third-party content moderation apparatus that, frankly, they seem to walk back in yesterday's commentary from Mark Zuckerberg, saying that that was a mistake because those third-party content moderators actually were not completely independent in terms of their thinking. Do we have a sense of how much advertising revenues increased, decreased, how much traffic increased or decreased after that move went into effect?
Well, there are third-party research that do show that a lot of that moderation has been successful in terms of reducing harmful content on the platform. And so when you look at Meta's own business, the success that it's had, the growth it's currently delivering, near 20% advertising revenue growth, it certainly seems to be working, or at least not holding the company back. So that's kind of the unknown here, is as they do start to pull back some of those fact-checking capabilities, will that have an impact on users, maybe certain groups of users not feeling welcome anymore and moving elsewhere? And will that create an opportunity? Ironically, it was Meta through Threads that took advantage of the troubles that Twitter and X were having, where they've built a business now with 300 million users. So we could see some others trying to come in here and take advantage of potentially the changes at Meta to jumpstart their own companies and their own businesses. That said, Meta still has 3.3 billion daily active users globally, so it's still going to be an attractive platform for advertisers to come to.
Stefan, when you zoom out, there was a larger message in yesterday's move by Meta, which was, how much does this signal that if you're in direct competition with an Elon Musk business, you potentially have a target on your back when it comes to regulatory impulses of this administration? And that was one of the speculations of a number of analysts yesterday, that Mark Zuckerberg was trying to get ahead of that. How much do you think that that is a real factor to take into account when having your corporate analyses of different tech companies?
Certainly, Meta is in a trickier position because you're right. They do have businesses that compete with the new president, Donald Trump, and with Elon Musk. And obviously, Mark Zuckerberg personally has had some challenges with Elon Musk and even President Trump with deplatforming it in 2016. So, these steps could be seen as steps to alleviate some of those frictions. But also, I think what we're seeing with big tech companies is a desire to avoid increased regulation, increased scrutiny over the next 4 years. It's like getting a house alarm. The main goal is to get person to move on. And so, Meta's trying to take itself out of the eye of the fire here in the U.S. But ironically, this could ratchet up pressure for them in Europe. Meta is already being investigated for being in breach of the Digital Services Act. There was some aggressive tone from the company yesterday about trying to push back on European regulation around censorship with the help of the U.S. government. We have the upcoming AI Safety Summit in France, in Paris, on February 10th and 11th, and we're starting to see this integration of social media and AI as AI agents and AI assistants like Meta AI, like Grok, like Gemini, like GPT, ChatGPT start to become more prevalent. So these are all important subjects outside of the U.S. And while Meta may have taken some heat off itself inside the U.S., it may be ratcheting up the pressure outside the U.S. Europe's 25% of revenues for Meta, so it matters.
Well, is that really the means to the end? Part of what Mark Zuckerberg maybe is trying to do is make sure that he has the backing of the U.S. government as he deals with this regulatory environment in Europe?
I believe that's part of the messaging from the company yesterday, is working more closely with the U.S. government on some of the pressures that Meta and other U.S. companies are feeling globally. And so that's certainly something Meta seems to be trying to put into place, is more of a partnership with the U.S. government than maybe it's had in the past. But again, these are sensitive times. This is a really hot button subject right now in Europe. We had the Southport riots in the UK over the summer, the UK government imprisoning some people for putting posts on Facebook inciting those riots. Of course, we've got Elon Musk right now courting the far-right party in Germany and hosting them on X, and leaders of these countries, leaders of France, leaders of Germany, leaders of the UK coming out publicly and trying to push back on some of these social media sites. So it's a really hot button subject right now, and you know, lots being said about the divide between the US and China in terms of technology. That's almost a done deal, but we may be seeing more of a divide coming between the US and Europe as well. The challenge for Europe is you don't have the homegrown companies to be able to replace some of these US platforms. So that's the challenge for Europe, and it always has been.
Hey, Stefan, that challenge is not going away anytime soon. Thank you, sir. Stefan Stawinski there on Meta. Meta this morning down about 0.4% in the pre-market. With an update on stories elsewhere, with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. NVIDIA's Jensen Huang, the CEO at the center of the AI boom, says that he's ready to meet with President-elect Donald Trump and offer his help to the coming administration. Huang spoke with Bloomberg's Ed Ludlow.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
Donald Trump has said that he will impose trade tariffs that may affect companies like NVIDIA, which rely heavily on overseas sales and outsourced manufacturing. We're going to have much more of that interview with Jensen Huang coming up in a few minutes. Now, Novo Nordisk is expanding a drug development deal with Valo Health to find new obesity and diabetes treatments using AI. The Ozempic makers pledging an additional $1.9 billion to the partnership. The original deal focused on cardiovascular disease and was worth as much as $2.7 billion for 11 programs. President-elect Donald Trump has stated that he would seek to prevent the construction of wind farms during his second term. Once back in the White House, Trump has the authority to approve or reject multi-billion-dollar wind projects planned off the coast of the U.S. on federal land. Trump criticized wind power as expensive and harmful to the environment. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the program, the U.S. labor market in focus.
We had a huge boom to refill all the jobs that were emptied out, that were vacated at the worst of the pandemic. It took several years for us to get back to that level. There's a lot of health in the U.S. labor market because the economy itself is very healthy.
Up next on the program, Andrew Honhorst of Citi.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Equity futures turning negative in the last 15 minutes or so. We're down about 0.08%. This story came from CNN this morning that the incoming president is considering a national economic emergency declaration to allow for a new tariff program. This is something the campaign talked about openly over the last 6 months or so. So I'm surprised by the extent to which markets have responded to it, and I'm questioning what's new about the reporting.
Well, that's exactly my point. I'm not sure why this is news to the financial markets. Potentially what they are picking up on is this seems like the antithesis, though, of the Washington Post story, which felt like maybe there's going to be a more narrow, targeted approach to tariffs. This feels like this is more of an aggressive approach to trade and tariffs.
Clearly very jittery about this story, and we'll stay on top of it for you. Under surveillance this morning, the US labor market in focus.
We had a huge boom to refill all the jobs that were emptied out, that were vacated at the worst of the pandemic. It took several years for us to get back to that level. There's a lot of health in the U.S. labor market because the economy itself is very healthy. We should continue to monitor the unemployment rate for people who've been unemployed for 27 weeks or more. We're seeing that creep up a little.
So here's the latest this morning. Investors looking to cap off a busy week of economic data with U.S. payrolls due on Friday. The median estimate in our survey calling for 163,000 jobs added and unemployment to hold steady. Andrew Hollenhorst of Citi has got a different idea on things. He's looking for 120 and a very different unemployment rate. And Andrew joins us now for more. Andrew, good morning.
Good morning.
Let's start with unemployment. You think that's the bigger issue. What's your call?
I think that's the more important issue. We're calling for 4.4% on the unemployment rate, which is not as big a move as it sounds like. And this is maybe the silliness of what we're doing here. But I have to get into the hundredths of a percentage point on the unemployment rate. We're at 4.24% unrounded right now. So that means if we just move up by a little bit more than a tenth, right, a tenth and a hundredth, then you're up at 4.4.
Why are you not dissuaded from your more bearish outlook on the employment market when you see things like the JOLTS data, the job openings data that come in hotter than expected, with actually the inflationary read-through of ISM coming in at the hottest level since 2023?
Yeah, I think when you look at some of this data, and this is the issue we're all dealing with, economists, the market, the Fed, there's so much noise in the data, and there are different details of the data you can look at and tell different stories. So the JOLTS report is a great example of that. If you look at the level of job openings, that's stabilized at a higher level than where we thought it would have stabilized at. So that looks quite healthy. If you look at what people are doing, which I think are the more relevant statistics in that report, you see layoffs are low, so that's very good news for the job market. But you also see that the hiring rate is quite low, and that actually surprised us to the downside yesterday. That got a lot less attention. It was low in October. October, we know we had the strikes, we had hurricanes, but then in November, it actually continued to move lower. You look at the quit rate. Are people feeling comfortable quitting their jobs? And this is kind of, goes back to what you were talking about with companies bringing workers back 5 days a week, right? People are not feeling as comfortable now that they can find a new job if they leave their job. So those are the kinds of signs of softness that we're seeing in the data that we think are going to continue to feed through and lead to a higher unemployment rate.
Yeah, just talking about the quits rate, that was 1.9%. It was tied with the lowest rate going back to 2020, right. Talking about that dynamism. I just wonder how offsides you think this market is, how much pushback you get, and what you say to people who say, you've been out of consensus for a while, the data's been surprising to the upside, why aren't you capitulating?
Yeah, so I mean, if you look at how much we've moved, it's really been incredible over the last 6 months or the last 3 months. And September, after we had the weak jobs report and the Fed was cutting 50 basis points and the Fed was quite worried about unemployment picking up. Then we have had a run of better data since then. We're trying to look at the underlying trends and not kind of change the view every month based on where an individual data point is coming in. And I think, and I don't blame the market, because I think, like I was saying, there's been a lot of noise in the data. The Fed is reacting to that noise in the data. So that means we've had 10-year Treasury yields that have been all over the place. We've had 2-year Treasury yields that have been all over the place. I think we're just going through a phase now where we've seen some better numbers. That unemployment rate at 4.24%, it would be 4.6% if not for the participation rate dropping. And I think we'd be in a very different discussion, right? We'd be having a different discussion right now if we were at 4.6%. So it just shows how quickly the narrative can change.
Will you maybe change your mind January 20th? Is the president-elect's immigration policies that he's talking about going to mean a tighter labor market?
So this is part of the issue with trying to do a forecast here, is that these policies do matter quite a bit. That's why the market is moving so much on each of these headlines and will continue to move. And it's not necessarily January 20th when everything is going to be answered, because yes, we probably should get some answers on immigration. I'm really interested to know, what does this reconciliation package look like? What's in this fiscal bill? If it's just extending existing tax cuts, that's not a big new fiscal stimulus to the economy. That's just extending what's already there. If we're getting no tax on overtime pay and these other kinds of things that could push the deficit higher, then that is more stimulus. That would change the Fed's view. That would change my view. Let's see what happens.
Just quickly, in about 15 seconds, if you can, if we get 4.4% this Friday, 120, is that sufficient to cut rates at the end of this month?
I think they may still pause even in that event. I think they have to see something in addition to that. It probably sets them up to continue cutting later this year, but they've really signaled towards this pause in January.
Mike Schumacher of Wells Fargo is saying that if we get that 4.4% that Andrew and the team are looking for, it would be ugly, and we'd see the 10-year yield falling 20 basis points in that scenario. We've had a big move in the other direction over the past few months. Andrew, it's good to see you, sir. Thank you. Andrew Hottenhorst there of Citi. Up next on the program, Mike Wilson of Morgan Stanley. Rob Casey of Signum Global Advisors will catch up with the New York Congressman Mike Lawler and Parag Garvey of ING with some big moves in this bond market in the last 24 hours. Not just stateside, but worldwide. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
The countdown is is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We're going to that point where rates are the things that pressure equities.
Markets are pricing that rates will stay higher for longer, and therefore we will not get all these cuts.
Fed communications is always difficult. It's difficult for any institution that is dealing with uncertainty.
We're seeing that term premium, that uncertainty factor really start to rise at a more rapid pace.
We're preparing ourselves for another year of a lot of uncertainty and a lot of volatility in yields as we go in through this year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with some big moves in the bond market. Let's start with equities. Equity futures just about unchanged on the S&P 500. On the Nasdaq, a similar move. Some headlines in the bond market in the last 24 hours. The 30-year yield testing levels we haven't seen going all the way back several years. In the UK, you've got to go back several decades. 2008 for the last time we saw a UK gilt yield as high as it is right now. Across the curve stateside, we're pushing levels we haven't seen in more than a year. We've got a 10-year getting closer and closer to 5%, Bramo, 469.94. And I think the point we're making this morning, it's not just an American move. It's American-led, but we're certainly seeing big moves elsewhere.
And this comes with this resurgence of inflation, the stickiness of inflation that we're seeing around the world, but it's also coming with supply anxiety. And I think we have to keep harping on this because it's in the U.S. where the deficit is deepening. But the UK, you talk about some of the highest yields we've seen since 1998, the UK 10-year yield hitting the highest rate since 2008 just this morning. A question here about how much we have suddenly sucked the oxygen out of the room with U.S. yields being where they are for other countries to also finance deficits at a time of technological transformation and legacy programs that need to be financed.
It's a point we've made repeatedly throughout this morning, the crowding out of other countries. They're losing fiscal space, and maybe the American data, upcoming U.S. policies are going to make that even more difficult. Trade policy in focus as well. A report from CNN out in the last 30 minutes or so that the incoming president is considering a national economic emergency declaration to allow for new tariffs. Now, I have to put this out there. This is something we've heard from the incoming administration several times. Using so-called IEEPA is not new.
And he threatened to use it as well in his first iteration as President of the United States in Trump 1.0. There's a story out this morning from Jenny Leonard, who is a fantastic trade reporter, and she talks about Trump has always played his unpredictability as key to his leverage. And that is almost probably what you see in a lot of these stories. Who was leaking to the Washington Post? Who was leaking to CNN? You can see the rival factions within the incoming administration on this key point, because there's different ideologies surrounding the president on how they think tariffs should be used.
The takeaway should be everything is on the table.
Exactly.
Big time. What we've got this morning in the FX market is euro-dollar breaking 103 again, 102.97. We're negative by 0.4%. Dollar strength is making a comeback off the back of these moves in the bond market, off the back of the pushback we've seen to the Washington Post story early this week about a potential of watering down tariffs at the incoming administration.
Basically, all roads right now, whether it's economic data that's been surprising to the upside with JOLTS and ISM services yesterday, or whether it's the idea of tariffs that could potentially hurt the rest of the world more than the United States, it's all leading investors to push back their expectations for the Fed to cut rates until later this year, reducing the space for them to do that and increasing inflationary pressures, and that's the reason why the dollar seems to be ongoing the haven for a lot of people.
The ISM services print yesterday really got this conversation moving in a bigger way this week. We've got more data this morning. ADP at 8:15 Eastern Time. Jobless claims brought forward a day because of the late President Jimmy Carter's funeral tomorrow. We get jobless claims at 8:30 this morning. Then it's on to payrolls this coming Friday. Coming up this hour, we'll catch up with Mike Wilson of Morgan Stanley on the breakout in bond yields, Rob Casey of Signum Global Advisors as the incoming president heads to D.C., and we'll speak to the Congressman Mike Lauder as GOP lawmakers look to extend and defend Trump's tax cuts. We begin this hour with stock steady, investors taking stock of an equity and bond market sell-off in the last 24 hours. Mike Wilson of Morgan Stanley saying equities are rate sensitive once again, which is another reason to stick with quality. Rates are the most important variable to watch in early 25. Mike joins us now for more. Mike Wilson, good morning. Happy New Year.
Good morning, John.
It's good to see you, sir. Let's start with the bond market and the importance of it. What is driving these yields higher, and how important is the why to the equity market?
Yeah, that's the right question. It's not just rates are going up, but why are they going up? I think Lisa mentioned a few things that are driving it in our view, which is some of the fiscal sustainability questions. We have a new administration, and while it is the second version of Trump, it's still uncertain, right? It's a new administration. There's a lot of new cabinet members. We just don't know. And usually the first quarter after a new president and new administration comes in, the markets typically don't do that well, right? We rally into the election, have a relief, and then we have these variables that we don't know. So the main risk that we talked about a month ago was probably U.S. dollar strength and rates. And that was always our view going into the election, that Trump would be good for stocks and probably not as good for bonds. And that's exactly what's playing out. So we had this euphoria around the election. We're getting a pullback on that. There's two things that are driving rates now. I think it's more about inflation and fiscal sustainability than it is about growth. And that's the key. And that's why the rate sensitivity now matters for equity multiples. We track this closely, right? The correlation between multiples and rates flipped negative again when we crossed over 4.5%. Almost exactly what we thought, because that's what we experienced last year in April. So it makes perfect sense. So this is the issue. We don't know how it's going to resolve itself, but until this does resolve itself in a favorable way, meaning rates go back below 4.5% and term premium comes down, right? That's the other part of the variable. So term premium's up 77, 80 basis points, somewhere in that range. That's a massive move, I mean, in a very short period of time. So I'm actually surprised that multiples haven't come down more, okay? Now, part of that is because the high-quality stocks are where people are crowding into still, not only in the U.S., but globally, and that's probably keeping the S&P multiple a little higher than it would be normally. But if this persists, multiples are going to come in more.
That mix is toxic for risk appetite, the way you've laid out things. We had Torsten Slok in your seat yesterday from Apollo, who raised the risk of a repeat of 2022. Would you share that fear, a year in which stocks and bonds do poorly?
Yeah, I think that's fair. I don't think it's going to be nearly as severe. I mean, the Fed's not raising rates. I mean, in 2022, I mean, they raised rates 400 basis points, and that's not happening. So I think that's a little extreme to say that, you know, bonds are not going to sell off that much. Okay, that's point number one. Point number two, though, is that multiples are much higher coming into this year than they were, say, in 2022 relative to where bond yields are. So in other words, I've been surprised, I think a lot of people have been surprised that multiples have gotten this high in the face of rates at 4.5%, 5%. I mean, that's where we've been for the last year. That's probably been the single biggest miss by most people, that multiples could be this high. So you have more give, I think, in multiples to come down, even if rates just stay in this range. Like, they don't have to go up 100 basis points for multiples to come in 10%. And that's what we're trying to figure out. So what do you do in that environment? Well, you still stay at the quality curve, okay? That's typically what works. And if you look at what happened, by the way, in the fall, the low quality stocks absolutely went bonkers. So that has to come out of the market. That's where we would be most concerned, or most kind of area we'd be most avoiding for the next sort of 3 to 6 months.
What's interesting to me is how much the narrative has shifted around which area of the equity market is most rate sensitive. At one time, it was considered the high-flying tech stocks that would be really hit hard. Now you're talking about actually some of the rest of the index that you think are going to have to come in. Is that how you'd frame it, that essentially tech stocks are not nearly as rate sensitive as a lot of people used to think they were?
Well, let's be clear. Not all tech stocks are created equal. Okay, so like you got to separate, you know, the 10 magical stocks, whatever you want to call them, versus everybody else. If you look at the average tech stock, right? You look at the equal weighted tech index. It's been lousy, right? It hasn't performed that well relative to the overall market. It looks like the average stock. So once again, we're talking about monopolies here, okay? Monopoly businesses, high quality businesses, and it's not just tech stocks, right? There's about 30, 40, 50 types of these businesses. They will typically hold up until growth becomes a serious problem. Like, that's not where we are right now. We're not in a recession. We're not in a situation where growth is going to really disappoint like it did in 2022. That was the big difference, I think, in 22 versus today, is that 22, we had a massive earnings recession. Okay, I mean, and led by the Magnificent Seven, by the way. That's not what we're forecasting right now. So that's what probably keeps a bid into some of the higher quality parts of the market. Now, having said that, if we go through 5% and term premium continues to go, yeah, the exposure in the equity market is in that space, and those stocks will eventually get clipped the hardest. But that's not, we're not quite at that threshold yet.
John was mentioning Dorson Slock, a number of other guests yesterday were talking about how important it is to have an increasing allocation to cash at a time when there is going to be a lot of volatility and there is great uncertainty about rate sensitivity as well as fiscal policy in Washington, D.C. Do you agree with that?
Cash is great right now. I mean, you're getting a really good real return. You have no duration risk. Like, what's wrong with cash? Doesn't mean you have 40% cash, but like, we're still very much short duration. Right, so when I say cash, it's like 2 years and in. I mean, that's like cash management. By the way, that's what most clients have been doing. Having a barbell of kind of your equity portfolio, your risk assets, and then within your fixed income portfolio, they've basically shortened their duration. So that's essentially how people are positioned: cash heavy, and then maybe taking a little more risk in their equity portfolio. That barbell's worked quite well, and I don't see why that's going to change.
You said one thing that's different now than in 2022 was the Fed was raising rates. We just had Adam Posen on, who thinks that the Fed's going to be forced to raise rates this year, though, because of what's going on, the policies in Washington, D.C. and sticky inflation. Do you think there's no chance that the Fed raises rates this year?
No, of course there's a chance. I mean, it's not our house call. But if things continue to move in this direction, let's say we get an oil risk, to the upside. Oil's kind of making a move right now. I mean, that could cause the Fed to raise rates 25 basis points. But even if we say that, okay, we're not raising 400 basis points. That I'm very comfortable saying the chance of that is zero. Okay, right. So that's how I think it's different than 2022 in that sense. I don't think there's as much downside for rates, but that doesn't mean there couldn't be 10% downside for many stocks, just if rates stay at this level.
It's only the second week of 2025, and already we've had multiple narratives on fiscal expansion, on tariffs. What's one thing you would love to have clarity on to understand the market this year?
Well, I think clearly tariffs is going to be the one that is the most, for equity investors, that's going to be the biggest focus, because that can affect earnings probably the most severely in growth. Right, immigration, I think, is going to be kind of a push and take, and I think the other one is taxes. Are they going to try to get more tax cuts through, or are they just going to try to extend the existing tax cuts, or the current tax law? And that will affect. I think that will affect rates. So it's really tariffs and taxes. I don't think we're going to know about taxes for quite a while. I think tariffs we're going to know quite a bit in the next month or two. And we've said this for a while. We said we think the first half is going to be choppy. Okay, second half, if they can execute on all these policies and we can kind of get to a point where the markets get comfortable with this, the second half of the year could be much, much better for equities.
What do you like? Where are the opportunities? I mean, there's hiding out in quality stocks, but is there anything that's getting you actually excited?
Well, I think the area we've been most bullish on is financials. I do think that's an area where it seems to be a lot of a coalition around deregulation. There's pent-up demand for M&A. There's pent-up demand for other capital markets activities. So I do think financials is an area we continue to think there's value there, and that's a global call. The second one is probably energy and commodities and materials. These parts of the market that, like, we can't do all these things everybody wants to do, like build data centers, add infrastructure, robotics and all these things. You need materials, you need energy for that. So I think those are areas that have been overlooked by the market, underappreciated by the market, that could be quite interesting this year.
Mike, good to see you. Enjoyed the note to start the week as well. Right. Mike Wilson there of Morgan Stanley, thank you. Yields pushing higher on a 10-year, up by another 2 basis points, 3.470. The spread between the 2-year and the 10-year, 341 basis points now. So that's a steeper U.S. yield curve.
And it's the steepest going back to 2022. It raises the question, is that a positive thing? Is that a normalization? It'll definitely help the financials. Or is this a negative thing, portending the idea of stickier inflation and a higher term premium that could be punitive?
I think Mike said it well, put it perfectly. The why is really important here, and the why is not good. It's not great. It's about prices paid on an ISM. It's about a fiscal trajectory of the United States. All of those things adding up are not good for risk appetite.
You raised this point, though, and I think it's a really important test that comes on Friday. How much this market has baked in a higher inflation rate that could be absolutely torpedoed if we get an employment report that underwhelms, that comes in light, how much we could see a rally. And I think that's going to be an important test. If we see that, what that does to the entire narrative.
Shall I tell you who needs a downside surprise on Friday? The UK gilt market.
Yes,
without a doubt. If I'm in the UK right now at Treasury, I'm sitting there like this, a Friday, 8:30, saying, please, downside surprise, because this gilt market's running away now. Yields are up on a 10-year UK government bond by 10 basis points on the session. We're pushing higher and higher.
Yeah, it's the highest levels in that denomination going back to 2008 at a time where you have growth that just isn't performing. And that's something else Mike Wilson said. This is on inflation and this is on fiscal. Globally, this is not on growth, and that is a toxic mix for a lot of countries.
Bond yields up across the curve. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Los Angeles is ramping up evacuations as the Palisades fire grows in size. The uncontrolled fire is threatening densely populated Santa Monica, California. Widespread and damaging wind gusts are expected to worsen, hampering efforts to contain the fire. The fire was at almost 3,000 acres, and 2 other blazes flared up overnight. Exxon predicting lower oil prices that will hit their production division by about $700 million in the fourth quarter. Refining and chemical margins also shrank in the final months of 2024, but were partially offset by higher U.S. nat gas prices. Exxon's guidance is a sign that the fourth quarter was a tough one for big oil. And CNN reporting the last hour that President-elect Trump is considering declaring a national economic emergency to provide the legal grounds for universal tariffs. 4 sources familiar told CNN that no final decision has been made, but that Trump is fond of the measure since it would give him wide-ranging jurisdiction on how to implement tariffs. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, Trump heading back to Washington.
I like one big, beautiful bill, and I always have, I always will. But if 2 is more certain, it does go a little bit quicker. I can live either way. I like the idea of the one big bill, but I can live either way.
A conversation up next, live from New York City this morning. Good morning.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Check out stocks and check out bonds. Bond yields pushing higher once again with 3,470 On 10s, your 10-year this morning up 3 basis points, 471.57. Has taken down equities and pushing up the US dollar. Equities down 0.2%. Euro dollar breaking through 103 again, 102.91. We're negative by 0.5. Under surveillance this morning, Trump is heading back to Washington.
I like one big, beautiful bill, and I always have, I always will. But if two is more certain, it does go a little bit quicker because you can do the immigration stuff early. We have a leader that I have a lot of confidence in. I think he's going to be, hopefully, a great leader, a great speaker. I can live either way. I like the idea of the one big bill, but I can live either way. But they'll be coming down. The senators also will be coming down, and then ultimately we'll be meeting in the White House in a few weeks.
So here's the latest this morning. Trump reportedly heading to Capitol Hill later on today to discuss his agenda with Senate Republicans. The president-elect signaling he would accept 2 separate packages to push his agenda through. Rob Casey of Signum advises saying the most likely path forward for the now-seated Republican Congress is one massive, all-encompassing reconciliation package. The most significant issue for Republicans is timing. Speaker Johnson's goal of April is ambitious. Rob joins us now for more. Rob, good morning. It's good to see you. Got to start with this one. Canada becoming the 51st state, renaming the Gulf of Mexico, whole range of issues including Greenland and Panama. When a client called you yesterday and said, Rob, I missed the news conference, what happened? What on earth did you tell him?
Well, I mean, you have to see through a lot of that noise, right? Canada won't be the 51st state. Greenland certainly won't be the 52nd state. Both countries have already come out and said that pretty clearly, as if they had to. But intermixed in there, you know, we're talking about 5% of contribution to NATO. We're talking about all energy, the border, all these things that really are policy priorities. So, you know, you have to ignore the Canada and the Greenlands of the news conference, seemingly every news conference, and focus on what matters. And it's in there. You just have to look.
And Panama Canal. So what is he getting at?
Well, I think he's getting at a few things. First of all, there are geopolitical, you know, trade flashpoints and choke points that the U.S. has to ensure remain open, right? Not only over the course of the next 4 years, but you know, into the future, generally speaking. The Panama Canal is one of those. Greenland is a vital military base for the U.S. We have a military base in the northeast of the island that really does a lot for our missile defense system. So there are all of these, right, necessities. The U.S. does not control these places. The U.S. won't control these places, but we need to have access to these places. And so in the more broad geopolitical competition, I think offense is the best defense. So Trump is going to talk about wanting to expand these presences rather than eliminate them.
Drilling down to potentially the substance the president-elect was trying to get to is that he cares a lot about national security and economic security. And while maybe he's an isolationist, he's using this imperialistic language because he cares about those 2 objectives. So if that's the case, how do you think he's going to implement some of his trade policy like tariffs? Because just in this week alone, we've seen 2 different potential paths.
Yeah, so I mean, I would put the tariff conversation in 2 buckets. The first is very ideological and punitive. I would put Europe on the top of that list. We think tariffs on Europe are probably going to come earliest, maybe not on day 1, but certainly before April. And I would also put sort of part of the China tariffs on that. You know, in that punitive bucket or really ideological bucket focused on decoupling from key sectors. I would honestly say the rest, especially Mexico and Canada, has to do with, I mean, wanting to get the best deal, wanting to incentivize, you know, eliminating drugs and migrants crossing the border. So, I mean, if I'm Europe on tariffs, I'm really worried. On China, I think there's some daylight for agreement, but I think, you know, in the second half of the Trump term, we certainly will see efforts at decoupling. Everyone else, I think, it's part of the conversation.
So back to John's original point, when he was leading in your note about this negotiation on 1 big bill or 2 potential bills, Trump's talking about the fact that tariffs are going to be the main means to pay for it. So does he need to have a lighter touch on tariffs until those bills are decided?
Well, I think one thing that we don't know this for sure, but I can almost guarantee that we will not see tariffs passed as part of that reconciliation process. Now, maybe that sounds like going out on a limb, but from the conversations that we have in Washington, D.C., Congress members do not want to vote on tariffs, right? Because they don't want to be on the hook when tariffs prove to be inflationary, when tariffs, I mean, cause significant retaliation from Europe and particularly from China, which hurts farm and ag states most frequently. So members of Congress really don't want to legislate tariffs. Trump is going to have to do it via executive order. He can and will do it via executive order. And to a certain extent, maybe these tariffs do pay for the broader Republican agenda, but they won't be part of the same package.
On a related note, if someone had called me, as John had put it, and asked, I said I hadn't really seen the press conference. What did I miss? I would have said, the most important thing that you missed was that Donald Trump said interest rates are far too high. And that's very concerning. And I know you would say very in character.
A bit of home bias.
Well, it is a bit of home bias. But when you cut through the noise.
I'm not sure the Danish quite feel the same way.
Well, okay, the Danish can worry about Greenland, but I'm worried about whether this is something that Donald Trump can pay for and whether he cares about what the bond market is saying and what the signal is from term premium that are climbing to the highest levels that we've seen in a long time. How much of a signal is that? How much is that something that you need to pay attention to outside of some of what you call the noise?
Well, I mean, I think it could be an important signal, but at this point, I honestly don't think that Trump and Republicans are worried about paying for these bills. I mean, what we hear from D.C. constantly is the market will have to move before legislators take, essentially the bond market, but more, I would say more importantly, long term, just the question of the deficit seriously. Legislators at this point, they can talk about the deficit. Some Republicans are certainly deficit hawks, but when it comes to are we going to pass Trump's agenda or not, I mean, frankly, they're going to do it whether or not it's deficit expansionary or not.
What's interesting to me is that late last year, people were saying ultimately one of the big checks on Donald Trump would be the stock market. And frankly, since the bond market has such a big impact on the stock market, the bond market as well. Are you saying that's not true? That actually what we're seeing in the opening salvos is the opposite? That actually is not a check at all, and that it's some of these larger issues that he's trying to get at that really will drive what he does?
Yeah, I think for one reason in particular, Trump is less focused on markets in this term and will be than he was in the last term, and that is he's not running for re-election, right? So it really is, he has 4 years to enact his legislative agenda, the policies that he's talked about now for 12 plus years, and I think any hurdle to that, is less important than it was 4 or 8 years ago. If there's a huge, significant market reaction, that's one thing. But Trump, at this point, I mean, he's talking about taking over Canada and Greenland. He's not answering to that many folks, right? That there are not many folks outside of the administration. Frankly, there are not many folks inside of the administration who are going to curtail the Trump agenda. Now, Congress might not be able to pass all of it, but they're not going to put up any roadblocks.
Just quickly, how big is this one big, beautiful bill going to be?
Really big, smaller than they would like it to be.
Is that a 6 handle? 7?
Not 7, because
Okay.
I don't think a lot of the no tax on tips, no tax on overtime.
But you're north of 5?
Yeah, at this point, I think so.
Wow. All right. Rob Casey of Signum Global Advisors. Thank you, sir. North of 5. And baseline for many people, we've said this a few times, to extend TCJA, that's 4 to 5 anyway, so what goes on top?
They might have to extend TCJA only for maybe 3 years and then go back and try to re-extend it again because they don't want to add that much debt.
Will the bond market be a constraining force on these ambitions? Yields are up this morning by close to 4 basis points. The 10-year 472. The 30-year getting closer and closer to 5% at 4.96. Up next on the program, we'll catch up with the Republican Congressman Mike Lawler. That conversation just around the corner.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equity markets down across the board here on the S&P 500, negative by 0.4. On the Nasdaq, down by 0.5. On the Russell, the small caps down by more than 1 full percentage point. The why is on the next board. Switch up the board, turn the page, and get to the bond market story. This is what it looks like. 10-year yields higher for 4 consecutive sessions. Yield levels we have not seen since November 2023. At the longer end on a 30-year, levels we haven't seen since October 2023. I want to point this out because I think it's really important. This is not just a US story, it's global. Check out the UK, the gilt yield, higher by 10 basis points, 4.78. And check out what's happening with sterling. You're not getting sterling strength off the back of this. Cable's down by 1 percentage point and changed, 123.35. That is an ugly picture for the British authorities this morning.
Because they don't have what the U.S. has, which is a strong dollar, and the fact that people still want to invest in the U.S. even at higher yields. And this raises a question, how do they combat slower growth and high inflation? It creates a real quagmire for them.
What a ride 25 is shaping up to be. We're 8 days in. We're 2 hours until the cash open. Let's get you some movers. Here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. And that whole conversation around bond yields really plays into big tech and duration. That's not a wholesale ransacking at the long end. That's just mild bearishness, not vigilantism. Apple this morning, some of these tech stocks are going to suffer if these yields continue to drive higher. Apple promised Indonesia that they'd spent more than $1 billion making the AirTags. That is not enough. This is actually Trump foreign policy in Indonesia. They say, you want to be here? You want to sell more here to 280 million potential customers? Build your factories here. Access is everything. Samsung are doing it. Xiaomi are doing it. So again, we're just on the back foot this morning overall on tech, down by 0.5%. Now, how do you lose friends and alienate people? Great book by Toby Young. D-Wave Quantum is up 1,000% last year. Jensen Huang, very useful quantum computers are likely decades away. 15 years away, that's when they become a possibility. Possibly 20 years away. That's how you lose friends and alienate people. I take you to Novo Nordisk. A couple of weeks ago, it came on, stood here, talked about CagriSema. This is one of their new GLP drugs. And the news there was down 29%, was you lost less weight than they had estimated you would get. Today, UBS say this is an attractive proposition. They move to buy from neutral. They do shave the price target to 750 Danish kroner from 1,100. The sell-off is overdone. Positive inflection point for GLP-1s. I mean, I can hear myself almost, rallying behind UBS here. Anyway, the point about it is, it's whether you think that a wipeout on that day is a sufficient entry point for you now. That's the trajectory for the moment. Jonathan.
That's Cranny. Thank you, sir. Appreciate an update there on some of the movers. Lots going on this morning. Equity futures session lows were down here by 0.4%. Under surveillance this morning, Canadian political leaders firing back at President-elect Donald Trump's continued comments about the U.S. annexing Canada. Outgoing Prime Minister Justin Trudeau writing on X, quote, "There isn't a snowball's chance in hell that Canada would become part of the United States." Conservative Party leader Pierre Poilievre saying, quote, "Canada will never be the 51st state, period."
Well, I think what you see here, and I want to lean into the individual that likely is going to be the next Prime Minister of Canada. He was talking about in his statement that Trudeau didn't do a good job of explaining how much Canada helps the U.S. when it comes to things like oil and gas, agriculture. This is going to be a very interesting one to watch. I do think the Republicans just love trolling Trudeau, and I wonder if the relationship will change if it is going to be a new prime minister.
Well, I wonder exactly to that point, if this is sort of the goal for us to be talking about this with Trump posting on Truth Social. Many people in Canada love being the 51st state if Canada merged with the U.S. Together, what a great nation it would all be. Honestly, how much this is just trying to change the conversation to something that is not going to happen.
There's an important conversation to be had on some other issues, including this one. The incoming president also saying at a wide-ranging press conference at Mar-a-Lago that NATO nations should spend the equivalent of 5% of their economic output on defense, escalating his demands on European allies to more than double the current target of 2%, which many of those nations have fallen short on repeatedly over the past few years. I would say this, that I think some of the bond market moves, to an extent, not a great extent, but are a factor in what's happening here. They're going to have to spend a lot more on defense. And I'm not sure how much space they've got to spend on defense outside of places like Germany.
And they're going to have to spend a lot more defense whether or not Trump basically pushes them to spend 5% of their budgets on NATO. This comes down to national security that's being threatened pretty directly by Russia. And so you have to imagine at a place like Germany, if you look at boons, right now yields the highest levels going back, hovering around 2023. Because why? I mean, are they really dealing with an inflationary shock? It does pose that fiscal loop that we keep talking about.
It's at 2 now. He's talking about 5. Over the summer, I wrote about the Trump team eyeing 3%, and I think that's likely where this will end. So not as much spending as 5% of GDP, which I don't think the United States is at. It's not, but definitely more than the 2%, and he is going to make this a priority.
These are countries that failed to get to 2. They certainly struggle to get to 3. Never mind getting to 5. I want to give you an update on this. Los Angeles is ramping up evacuation orders as the Palisades fire continues to rip through the area. Parts of northern Santa Monica now under alert as widespread and damaging wind gusts threaten to worsen the situation. Tragic pictures coming in overnight.
Yeah, with evacuations being ordered all across different places. Honestly, I feel for them. It sounds like the winds are going to pick up, so hopefully everybody stays safe and this really does stop sometime soon.
We'll keep bringing you updates through this morning and through today, of course. Let's turn back to politics. Republicans in Congress are gearing up to negotiate an extension of Donald Trump's 2017 tax cuts. A group of House Republicans were invited to meet with Trump this weekend at Mar-a-Lago and are expected to push to include an expansion of SALT tax deductions in Congress's upcoming package. I'm pleased to say that joining us now is one of those House Republicans, Congressman Mike Lawler of New York. Congressman, fantastic to catch up with you once again, sir. I just want to know from your perspective how many friends you have outside of New York in the House that would be on board with this effort.
A lot more than people realize. Obviously, New York, New Jersey, and California, 3 of the high tax states where this has most acutely impacted. Certainly, we have a coalition, and given our small majority in the House, it's certainly a powerful coalition. But there's other states and members across the country in which, over the last 7 years, they've seen their own taxes rise up against that $10,000 cap. So, quietly, there's a few more members than people would realize. Look, the cap on SALT was a pay-for the 2017 Tax Cuts and Jobs Act. That's it. It was used as a pay-for to pay for other provisions within the tax bill. The $10,000 cap is woefully insufficient. It's had a negative impact on states like New York. Now, we can get into how New York excessively spends. They've increased their state budget by $61 billion in the last 4 years, for instance. That needs to change. But taxpayers should not be penalized by living in a high-tax state. This is double taxation. And for those of my colleagues that say this is somehow a subsidy, the fact is New York contributes more to the federal government than it receives, and more than some of these states in which, my colleagues will claim that they don't want their taxpayers subsidizing New York. But the reality is it's the other way around.
Congressman, you certainly don't have a friend, though, in someone like Lindsey Graham, the senator of South Carolina, who said, why should I, from South Carolina, pay for what's going on in some of these blue states. And he's pushing for this for the two-bill approach, because he doesn't want to talk about taxes. He thinks it's going to take too long, and he doesn't, frankly, want to sign up for SALT. How are you going to convince the president this weekend that you should do one bill together and make sure SALT's included?
Well, respectfully, South Carolina is one of those states that gets more back, certainly percentage-wise, than New York does. So, you know, if we want to talk about subsidies, we can go chapter and verse through everybody's subsidies that they get. Look, with respect to one versus two, the president has already made clear he is moving forward on one big bill. We need to deal with taxes, the border, energy, debt, among other issues. And the fact is, given our small margin in the House, we're going to need everybody's vote and everybody on board. Two track bills are going to make that harder. So while it may take a little bit more time to get one bill negotiated, it is necessary if we're going to get all of these issues addressed. And I think the president understands that. I think that's why the president made clear last week one bill, and that's how we are proceeding forward in the House. And look, ultimately, our Senate and House Republican majorities are going to have to work together. Nobody's going to get everything they want out of this. There's going to have to be a good faith negotiation if we have any chance of passing a reconciliation bill.
I was one of those individuals who watched your Festivus airing of grievances during the Christmas week, and you did a little bit of a wink at your potential future, maybe becoming the governor of New York. To make sure you could potentially go down that path, do you need to secure a higher SALT tax break?
Look, regardless of whether or not I run for governor, this was a promise of mine, and it's a top priority for my district. I represent one of the highest tax districts in the country, inclusive of Westchester and Rockland counties, #1 and #2 highest property tax counties in America. So this is critically important to lift the cap on SALT. $10,000 is woefully insufficient. And, you know, this is something that I said I would deliver on, and we're going to as part of this reconciliation bill. Long term for New York, this is critical. We lead the nation in out-migration. Our tax base is eroding in large part because of the disastrous policies of Kathy Hochul and Albany Democrats. One-party rule in Albany has been an abject disaster. Whether you're talking about the affordability crisis or public safety, people being burned alive on subways, pushed in front of oncoming subway trains, Kathy Hochul now scamming New Yorkers out of $2,500 a year just for the privilege of driving to work, while spending billions of dollars of taxpayer money on free housing, clothing, food, education, and health care for illegal immigrants. New York needs change. There's no question about that. But from a federal perspective, we should not be penalizing New York taxpayers because of the disastrous decisions of Kathy Hochul and Albany Democrats.
And just to be clear, when it comes to the SALT cap, how high are you looking for it to be raised?
Look, I've introduced legislation, you know, my marriage penalty elimination bill reintroduced to raise it to $100,000 for individuals, $200,000 for married couples. This is going to be a negotiation. My colleagues and I are looking forward to sitting down with the president, having a discussion about it, hearing obviously what his priorities are as part of the tax bill, and working to a consensus. At the end of the day, my objective is to provide tax relief to hardworking Americans. It's incumbent upon everybody to negotiate in good faith, because here's the reality. If we do not pass a tax bill, #1, SALT comes back unlimited, but it is accompanied by the largest tax increase in American history. So it is important that we actually negotiate a fair tax deal for the American people.
In August, I just want to end on this, you were one of these individuals that wrote a letter to the speaker talking about that you didn't want the repeal of energy tax credits with the IRA. This is something that President-elect Donald Trump wants. Are you going to be trying to assuage him of your view over this weekend in Mar-a-Lago?
Look, many provisions of the IRA absolutely need to be repealed. What we signed on to a letter is that we were not going to just sign off on a wholesale repeal. There needed to be a discussion and, again, a negotiation. Companies make decisions based on tax provisions, and they need certainty. And there's already been significant investment, including in New York, based on some of these energy tax credits. And so we want to make sure that any changes are done smartly and not just wholesale repeal. So that'll be part of the discussion and conversation as we move forward. You know, again, I think the key here is to come up with a reconciliation bill that increases domestic production of energy, ensures the American people have a good, smart tax bill to reduce their taxes, reduce the cost of living here in the U.S., and ultimately secures our border. It's a lot of important issues that have to be included in this reconciliation bill. It's going to require negotiation, and it's going to ultimately require every Republican supporting the final product.
Congressman, as we speak, bond yields are climbing, and we've seen quite a significant move since September when the Federal Reserve started its rate-cutting effort. We've moved 100 basis points, and I certainly don't expect you to follow the ins and outs of fixed income on any given day, but I wonder whether you and your colleagues are sensitive to some of the pressure that's starting to build in the U.S. debt market.
No question. Look, our debt at $36 trillion total and counting is a major problem. And this is something that everybody in the Republican conference is in agreement on. We have to tackle our debt. We have to reduce our deficit spending. We have to right-size the federal government. Spending is out of control. Joe Biden's disastrous first 2 years gave us record inflation. It spiked the cost of living, and we have to unwind a lot of this. You look at a state like New York, it is floundering because of some of the economic pressures. And just think about this. The MTA has more debt than 80% of the states in the country. So debt is a major problem. It's something that we have to deal with across the board. We cannot continue to print and borrow money at the levels that we have.
Do you think we can afford to extend TCJA, which baseline is something like $4 to $5 trillion? Do you think we can afford to include an expansion of sold tax deductions? And Congressman, I wouldn't push back against anything you said about the effort that needs to take place elsewhere. I'm just wondering how much fiscal space you and your colleagues believe we actually have at the moment.
Look, tax policy is critical to economic growth. But it's one part. We need to increase domestic production of energy, which will help generate more revenues. Energy policy is also critical, not just domestically for cost, but for national security. You were talking, obviously, about the threats to Europe from Russia. Europe is still buying gas from Russia. It's idiotic. It makes no sense that they're helping fund the very war they're trying to stop. So there is a lot that has to be done here, including reining in federal spending. Obviously, as we work through the tax cuts, we will look to help offset some of the cost through spending reductions. So this is going to be a comprehensive approach to how we right-size the American economy. I do think it's possible. It's going to be one of the most critical things any of us ever do in our careers in government. And so we all have to be committed to the final cause here.
And we're certainly looking forward to continuing the conversation with you, sir, in your current capacity, and maybe in the future as the next governor of the great state of New York. Mike Lawler there. Congressman, thank you, sir. Appreciate it. The 10-year yield this morning up by 3 or 4 basis points. The 30-year up by 5, Bramo.
Yeah, question about whether the math works for the bond market, because right now people are trying to understand how do you offset the extension of TCJA at the same time when you're not going to necessarily cut Medicare or Social Security. And this has been really the needle that it's been very hard for people to thread.
I said this earlier this morning. The UK Treasury, the finance minister in France, they're all going to be watching payrolls on Friday because they do not want yields to push any higher from here. And I would also suggest they're all going to be watching the effort in Washington, D.C. the package they come up with, the size it is, because I really believe that the crowding gap, the global bond market, is a real force taking place right now.
And they're going to be watching at 1 p.m. today when $22 billion of 30-year bonds in the U.S. are going to be sold at a time where 30-year yields are currently at the highest level since November of 2023, pushing up against 5%. How messy is this? And that's really going to set the tone around the world.
This conversation continues up next on a program higher for a whole lot longer.
Normally, the textbook would say if you cut interest rates, long rates should also be going down. It is just really unusual that long rates are going up when the Fed is cutting.
That conversation up next.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Another interesting move in the bond market. Another day for it. Yields are higher by 3 basis points on a 10-year, 4.72. Under surveillance this morning, higher for a whole lot longer.
Normally, the textbook would say if you cut interest rates, long rates should also be going down. It is just really unusual that long rates are going up when the Fed is cutting. Markets are pricing that rates will stay higher for longer, and therefore we will not get all these cuts. The backdrop is that the economy is still strong. But the bad news, of course, is that rates higher for longer will continue to weigh, in particular, on balance sheets that are weaker.
We've had a 100 basis point move since the Fed started cutting interest rates. Parag Garvey of IG writing, as we progress through 25, our vision is for the US 10-year to head towards the 5 to 550 range. Parag, good morning. It's good to see you.
Good to see you, John.
What's behind this move over the past few months, the past few weeks?
A whole combination of things. But before we get to that combination, I think it's important to have context. I think one of the things that we can't just throw numbers out there. It's easy for me to say 5.5%. But the starting point here is that when you look at the Fed funds rate, fair value neutral is 3%. When you look at the 10-year fair value neutral, I think is around 4%. That's for SOFR. Treasuries trade 50 basis points above that. That's 4.5%. That's your starting point. I've spent the last 18 months convincing people that a 4% plus handle for 10-year Treasuries is not a high level. So you start at 4.5% and you ask yourself, where should it be given all the other factors that you have referenced? So fiscal deficit, inflation issue that's not solved, economy doing okay, and ambition from the current or the coming administration to cut taxes. All of that is in the mix and it's pushing up yields.
So does this mean you're not going to be buying today at 1 p.m. when the U.S. Treasury sells $22 billion of 30-year notes?
No, there wasn't much buying yesterday in 10s or the previous day in 3s. There was a 1 basis point tail at all of those auctions. Now, let's suppose today's auction goes well. It doesn't change anything. Yesterday's auction, I think, was the big one. That's the benchmark point, the 10-year point of the curve. So today is less important for me. We've had a decent concession today based off very little. The concession yesterday, at least, was based off some firm data.
The reason why I ask is because there's a real question of how much the increase in yields is directly tied to the potential supply that could come down the pike. How closely attuned are you to the size of the bill that gets passed in Washington, D.C. to decide whether it's a good idea to buy 10-year Treasuries at 5 or 5.5 or just to sit out entirely?
Yeah, it's absolutely crucial. It really is, because one of the things that we know with clarity at the moment is that there isn't a credible plan out there at the moment to cut the deficit. And we're sitting in an economy with a 7% deficit. Now, Brazil is sitting in an economy with a 7% deficit and is getting crucified. We're not, because we're the US, we've got the reserve currency and we've closed our eyes. But at a certain point in time, it becomes important. And I think we're beginning to see the beginnings of a creep of this type of psychology.
Is it a problem for everyone else before it becomes a problem for us? We're seeing some big moves take place in the UK, bigger moves in the United Kingdom, likewise in France. Is it a bigger problem for them than maybe it is for America?
As it always is with the US, we have such a huge impact on the global scene. We saw gilts hitting, local highs yesterday, significant highs. And you could argue even in the Eurozone, rates are higher than they should be under normal circumstances when you look at the economy, which is very weak. So there's a huge correlation trade out there. So yeah, for sure. And it has to be said that the US economy has taken this rate hike process remarkably well. I know we're cutting now, but the rise in yields as well, it hasn't toppled anything. So as long as that continues, there's a kind of a path for that to continue.
I think we've got to recognise that because it's important. We've handled these rates at these levels across the board at an aggregate level in a much better fashion than I think many people anticipated all those years ago when this process started.
Which, again, goes back to the ultimate question of, is this really very restrictive in terms of policy from the Fed if there isn't evidence of its restrictiveness in the outcome of economic growth?
Some big moves in this bond market worldwide. Parag Garvey there of ING. Parag, it's good to see you. 10-year yields are up by 3 basis points. The 30-year is up by 5. In America, the US 30-year, 4.96. Alicia Levine of BNY Wealth is going to join us shortly. We'll catch up with George Giacolarikis of Canaccord, Greg Dacko of EY, and Winnie Caesar of CreditSights. All of that and more in the third hour of Bloomberg Surveillance.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture. It's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Our base case is for volatility, episodic volatility.
Primary trend is up, but it's going to be delicate. There's going to be some things that are likely broken.
That top 20% of momentum is now starting to just be a little broader.
I worry about a 10 to 20% drawdown this year if inflation does in fact look like it's being sticky or moving up.
I don't know that I look at 2025 and see another 20-odd% return in the equity market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. So yesterday, the economic data shook up this bond market big time. This hour, we'll get the ADP employment report at 8:15, so about 15 minutes from now. 30 minutes from now, we'll get jobless claims, of course, brought forward a day because of the funeral of the late President Jimmy Carter. So look out for that number at 8:30 Eastern time. The estimate in our survey, 215, the previous number, 211. Just to get you up to speed, if you are just joining us on the price action taking place, not just in the United States, but worldwide. Equity futures on the S&P 500 negative by, let's call it a 1/10 or 0.2%, bouncing off session lows. We've got the Russell down by 0.75%. In the bond market, some significant moves, not just stateside, but worldwide. Yields are up by 2 basis points on a 10-year, through 470. On 30s, we're getting closer and closer to 5%, 495. But we're seeing bigger moves elsewhere. Look at the UK. Yields are up by 9 basis points on 10s, up 6. On 50s, up 9, on 30s. The long bond in the UK getting absolutely slaughtered.
And this comes at the same time that you're seeing a pound that's losing steam versus the dollar because they don't have the privilege that the U.S. has of being the fiscal currency of choice. Issue here around the world, and you've mentioned this many times, as U.S. sees yields creep higher, how much does that shift the entire global yield curve higher than it otherwise would be based on growth and based on inflation in places like Europe that right now are not seeing the same kind of momentum as you have in the United States.
These are places that already didn't have much fiscal space, and they're going to be being constrained by U.S. data, by upcoming U.S. policy. A big, powerful bill down in Washington, D.C. is arguably not going to help the debt fortunes of the British or the French, for that matter, and others too. How big is this bill going to be?
Well, Bob Casey, Jonathan said it to you, somewhere between maybe $5 to $7 trillion. That's how much this bill could cost. What they're talking about is money for immigration, energy, TCJA getting extended, maybe also adding some extras like no taxes on tips. We still don't even know how the sausage is going to be made, because the president-elect said yesterday, Trump said, well, he likes the idea of one big beautiful bill. Maybe it'll have to be two. Wall Street Journal editorial board this morning, will the real Republican legislative strategy please stand up? And even if Trump comes out today and says, you know what, I talked to the senators, I agree with them, we're going to go this two-track approach, he's then meeting with a bunch of House reps over the weekend. So by Monday morning, it could be a completely different narrative.
One message, though, is standing up, and this is the message the bond market is getting, and that's what Porrick Garvey just said, which is there hasn't been a credible plan to reduce the deficit in any of the sausage making, and that is what's getting the attention right now of some of the vigilantes.
And Lisa, you brought up a great point earlier this week. How much money the United States already just paid only on paying off its debt? The interest payments last year was what, $1 to $1.5 trillion? Unless you start looking at actually cutting Social Security and Medicare, we are not going to get our fiscal house in order.
There's an important point to make here, though, that the United States of America will benefit from the deficit spending that we do get from the upcoming administration. We will see the growth in America. The issue the rest of the world has is that the walls are going to go up. And if tariffs go up, you're not going to get the positive spillover to places like Europe, to places like the United Kingdom. They won't benefit from it. They'll just suffer, and they're suffering this morning.
And that's why people are looking at some of these yields that might look higher on an absolute basis in the UK and say, do I really want to own that, given some of these extra concerns and the fact that it's not going to stimulative spending that's going to actually boost growth.
Lots of economic data coming up a little bit later. The ADP report, the next stop. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth as a cross-asset sell-off takes a breather. We'll catch up with Canaccord Genuity on why they're still bullish Tesla despite the recent pains we've seen, and Greg Decker of EY on the Fed's policy tightrope in 2025. We begin this hour with stocks steady, recovering after a bond market sell-off hit equities just yesterday, erasing recent tech-fueled gains. Alicia Levine of BNY Wealth staying optimistic. We expect more volatility than in 2024, but also a positive year because the consumer is strong. Earnings growth will be in double digits, and the Fed, though pausing for now, still has a cutting bias.